Consistency is the biggest thing with anything in life. You have to give the statistics a chance to play out.
Trading should be mechanical. Trading should be the way that I interpret it to be and that I show it to be. Losses is like getting kicked in the nuts. You can't do anything about it. It hurts. Acceptance is the name of the game, because the same problems that you're going through as a small trader is the same problems you're going to go through as a big trader.
It's more gambling to be a long-term stockholder and not know what your exit criteria is or your criteria to take some off the table.
Think of how many truckers are going to lose their job as soon as Tesla solves FSD.
You have companies like Meta who have a whole different profit generation arm that can help feed into their AI initiatives. The only companies that really don't have that is an open AI. The more AI comes, the more you're going to see more traditional jobs for humans come up.
That is what's life-changing. Of the 5.5 million that I've made in the past 4 years, 1.8 of it came from Tesla. I think the biggest thing that I try to instill in my students more than anything, I think that the first and foremost.
So I had you on about a year and a half ago now. It's crazy. It's been that long already.
Yeah.
And if anybody wants to know more about Pete, you should go check it out. Pete has a crazy, crazy story, and he details it very well in that last episode. I think that episode really, at least for my following, and I think a lot of the Tesla community themselves, they got a real exposure to you. And, ever since we did that interview a year and a half ago, people have asked me like, when are you going to get back on with Pete? When are you going to talk to Pete again? So you've definitely become one of the few, I would say, outside of the Tesla community people that Tesla community loves. People love your stuff. And I'm sure you get a lot of that feedback.
Yeah, dude, it's been a lot of love. It's been really good. I've grown a lot in the past year, like from a follower standpoint, from a personal standpoint too. And I feel that the love, it's really weird because I feel that like social media gets such a bad reputation, and I'll be the first person to tell you like social media is poison, right? Like for like the 90% of it. But I feel that it's just because I've always worn my heart on my sleeve from an emotional standpoint, but also from like a trading standpoint when it comes to transparency, being right, being wrong, sharing exactly why I'm entering something, not deleting tweets after it doesn't go right, and I think most importantly, just being humble in the times that I also win, because you're going to lose, right? Like, so it's like, there's no reason to be like, you need to be humble in victory and defeat. And I think that that's something that has really helped me grow, but also like build an amazing following with the Tesla community and the trading community in general. And I think that that is probably one of the things that I'm most proud of, is like my community on X and on YouTube, because it's such a high quality, such a good representation of the best parts of social media, in my opinion, right? Like there's always some vile comments every once in a while. There's always some major negativity, but like that is what I'm most proud of, is like the quality of the community that I keep. And the fact that like I would go out to get a drink or get coffee with like anybody who follows me. I feel like the quality of the people that are in the community in general is amazing. So it's like what I'm most proud of.
Yeah, that's awesome. I couldn't agree more. You said something interesting there. You said that you've grown personally, but also in your trading. Just like curious, because you're interesting in the sense where you are a very emotional person. Like, I mean, if people should go again, watch that last episode that we did together. You talk about it openly, like you don't try to hide your emotion, but at the same time, in your trading, you have this ability to be very mechanical. I always tell people like this, at least this is my opinion, I'm curious your take, but people always say you need to not be emotional when you trade, and like you got to learn how to be unemotional. And to me, it's like, well, that's impossible. If all of a sudden you just made 6 figures on a trade, like you're excited, you're happy. You can't and guess what? If all of a sudden S&P's down 2% 4 days in a row and the whole market's crashing, that feeling in your stomach, like you're not going to train that away. Now, I think the skill set is, can you feel those feelings and still make the right decision regardless? That's different. And so I'm curious if that has anything to do with what you've grown personally and in trading, or or what changed?
Yeah. So, I mean, going off of what you said about, feeling emotions when you're trading and then not acting upon them, like that, in my opinion, that is the name of the game. I don't not feel emotions, right? Like I've gotten a lot better. I've dampened it a lot within my trading because there becomes a level after you've been doing this for so long that you understand that no amount of money you make today is really going to change what happens. And the more times that you deal with ups and downs, specifically the drawdowns, the more times you understand that just as easily as you make it is just as easily as you could pull it back. Right. And
Mhm.
so, like, if I'm up like 65% in the year, like my fund is up about 65% this year, trading predominantly shares. If I go on a 20% drawdown into the next 2-3 months of this year, that could happen. And that's fine. Right. I'm still up 40+% in a year, and that's fine. Right. So it's like I don't look at my net worth and I don't look at how much money I'm making, even in the business, and say to myself, like, this is what I'm going to base my life off of. This is what I have. This is great. Because then as soon as it pulls back, which it will, then you start to feel like, oh, I should have sold. I should have done this. So I think that the most important thing is feeling the emotions. Like I tell my students all the time that losses is like getting kicked in the nuts, right? Like you can't do anything about it. It hurts, but you just have to sit there with that pain, feel the emotions, feel it, and then just let it go away. And so I think that with me, I feel like I'm not a patient person, right? Like in my trading, I come off as patient because in my trading, I am patient, right? I am very disciplined in my trading, but it doesn't mean that I'm not sitting here like, bro, I want this to go faster. I want to grow faster. I want my business to grow faster. I want my following to grow faster. I want my fund to grow faster. Like, I still feel that way. It's just, I don't act upon it. And in my opinion, that is discipline and mastery over your emotions. That is stoicism at its core, right? It's not that you don't feel these things, it's that you feel them, you look at them, you understand that it's human nature, and then you do nothing about it. You go touch grass, you go hit the gym, you go work on a passion project, you go find something else to put that into. And where I've changed, I've kind of been that way for a very long time, but I think that personally where I've changed a lot is this sense of weight, like a good weight, but also like a higher weight of like I have more people who are following me. I have more people who are interested in what I have to say. I have now like multiple employees that I have to put food on the table for. Like all of this within the growing bigger, and I plan to grow a lot bigger too, has come with a lot more responsibilities, a lot of things that I personally like didn't expect when I first started trading, or even when I first started sharing things publicly. But I think that one of the things that I've also really in the past year understood is that, and it's so cliche, but like the journey is ultimately the goal. And you have to love what you're doing each and every single day. And you have to think about everything that you're doing in your life as like, is it long term scalable? Because in the
Yeah.
past 3 years, I've worked myself into the ground, and like not in a good way, right? Like I enjoy it and I love it, which is also because I work so much why I'm able to be patient in my trades, because I'm working 16 hours a day, right? Like I shoot all the content, I do all the live streaming myself, I do all of my trading. I'm constantly responding to everybody inside of my community. I have a team that I'm also helping to lead who's helping to build out, like we're building out a bunch of like financial tools and stuff going into the future, indicators. So I've got all these plates that I'm spinning and all these things that I'm doing, and like ran myself into the ground, like put myself in the emergency room, basically
Oh,
crash my adrenals. Yeah, crash my adrenals into the ground. And a lot of it in the past year has like woken me up to like, why? And for me, a lot of it is I think I've got this chance in this I've been blessed with this ability in my life, which I've worked hard for, that I need to milk it for everything that I possibly have. And like I said before with the community, there's so many people who are a part of it and who follow it and want my analysis on stocks, and Tesla specifically, that I feel I don't want to let those people down. And so the hardest thing for me this year and where I'm trying to develop the most is to kind of like not hold on to everything so tightly, not to hold on to the money, hold on to the following, hold on to the needing to constantly do more and to kind of like let go and get back into this flow of like following my passions, doing what I'm doing, and
Yeah.
kind of just like letting go a lot more.
Yeah. No, I feel that. I remember when I was, heavily doing a lot of YouTube content, orders of magnitude less than you. So let me just level set here, right? There's levels to this, but still for me with, what I was going through with, construction on a house and just life and work and trading and everything, it got to a point where what started off as a passion project turned into what you're talking about, where it's like, all right, well, let's grind, see like if we can make this bigger.
Yep.
And it got to a point where I was happy with what I had done. And then it stopped kind of becoming that passion anymore. And I
Mhm.
kind of lost the love for creating content. And, luckily, like I was telling you earlier, but plenty of people in the Tesla community that, have me on to do quarterly earnings on Tesla, and we do live streams, right? So lower effort things. But recently I've kind of turned it back into re-engaging in the passion of talking about the things I love to talk about, that in my day to day, there's only so many people in my life that I can talk about these things, especially at a deeper, more nuanced level. You talk to someone about, options, and they're like, oh yeah, I I bought a call once.
Yeah.
And they're like, oh, cool. Like, if I ask them, like, you ever sell calls? Like, I think I've sold a call before. You think you have? Like, what do you think? Like, all right, we're not even talking about the same language
Yeah.
here, but it's definitely, I've gotten that passion bug again. And
Mhm.
I don't know, it feels good to be doing it for, I don't want to say it was wrong reasons before, but for the right reasons again.
Yeah. For the love of it,
Yeah.
and I think too, there's like parts to all of us. And for me, the thing that I've noticed psychologically that has changed so much in the past 4 years of like really doing all of this publicly and making content and getting into all of that is that I spent so much of my life, and where a lot of my passion comes from is being a student and is learning. Like I love that more than anything. And before I had a following or content or all of this, 95% of what I did was learn. 95% of what I did was engage and be curious and learn new things and read new books and listen to new podcasts and like grow. And I do think I'm growing in different ways, but I've noticed that now I spend 95% of my time being the teacher. Right. And
Mm.
so there's like this burning part of me that's like, hey, dude, like we're talking about trading all the time and we're talking about this and you're pushing yourself in this different way. But like we need some time to learn. We need some time to grow. We need some time to like push the passion, because I'm still very, very passionate about trading, and I'll be passionate about trading and investing for the rest of my life, right? In like some regard. But I do also understand that there's a piece of me that I'm not necessarily like allowing to be itself because there's just no time, right? And it's like it reminds me kind of like a kid every day that's like pulling my pant leg. And it's like, hey, like let's go do this. Like let's go learn. Let's go read that book. You got all these books in your bookshelf. You're excited about this. Like you want to go. You want to understand this. And I'm like, dude, not today. I don't have time. Like I'll take you to the park. Like we'll do this next
Yeah.
time. Like, and then I realize like how long can I do that mentally before it starts to take a toll on you. And so what I've been trying to do in the past year is reevaluate my business and reevaluate my content and even my trading, like even down to how I'm trading in a way that is longer term sustainable so that I can spend more time to explore those passions, because the market is 100% of my brand,
Hmm.
but it's like 10% of me. It's 20% of me. Like there's so many things that I'm interested in. There's so many things that I love. There's so many avenues in life that I want to explore. There's so many aspects to that. And so while I want to maximize this opportunity that I have and help as many people as I possibly can, I also have to understand that there is a big portion of me that I need to service and help,
Hmm.
And I've noticed too that like from a lot of where my drive with content comes, because a lot of people are always like, dude, this is where like I'll get real honest with you, right? A lot of people are always like, if you have such good returns and if you make so much money and if you do all of this, like why are you making content? And like the truth is like none of that still makes me feel valid or enough.
Mm.
Like I feel like as humans, we spend like a lot of my drive and a lot of type A personality drives, I think comes from a feeling of insignificance, right? Comes from a feeling of like, I need to prove myself in this world. I need to prove myself that I should be taken seriously, that I am a different person that I was, that I am the person that I say I am. Right. And so what I realized with myself is as much as I really want to help a lot of people, there's also this piece in me that's like, sometimes doing it for selfish reasons. Sometimes doing it to like prove that like you did what you said you were going to do, or you are, like you are the person that you say you are, or that you are enough, or all these people who doubted you. And it's like, that's not healthy, like long term. You know what I mean? Now, I think it's good that I've been able to realize that and put a pin in that and understand like, hey, what are we doing? Are we making this content today? Or are we creating this new product because my ego wants to do it? Or are we doing this because it's genuinely like the best thing to do? And I think that that's where I've tried to stop chasing metrics so much and chase instead like what I actually think is the best thing to do, even from a trading perspective. Like my goal now is to stop focusing so much on what's happening day to day and more so what's happening for the next 6 to 12 months, right? Because number one, that is a lot more sustainable. Number two, it gives me, I think, a lot better ability from a content and a teaching standpoint to actually have something that has more shelf life. And I think that it also allows me to not get so wrapped up in what's happening day to day and allowing me to make the decisions that I think are best for the long term, whether it's my trading or my business or just even creating content in general.
That was heavy, man.
Yeah.
Before we talk too much about markets or trading,
Yeah.
what are those other things that you're interested in learning? Like, do you have a list of things that, that you have your mindset like, man, this is something I want to go. I mean, I don't know, playing the guitar,
Yeah.
jujitsu, climbing a mountain. I don't know.
All of them. Yeah, no. So it's funny. I did a lot of this realization because in my basement right now, I jokingly refer to it between me and my brother who I live with, and I say like, oh, it's the basement of broken dreams and broken hobbies, or like the basement where I said the basement where hobbies go to die. And I go downstairs to do laundry, and I look in the corner, and there's my drum set, there's my guitar, there's all my heavy bags, there's like my old gi for jujitsu. There's like even Magic the Gathering, like old cards that I used to play. And I'm like literally like my old bow because I wanted to get into hunting and like kettlebells. And I'm like, there's everything that I love to also do besides trading that I never do because I have to like it's weird. It's weird because psychologically I'm suppressing it. And physically, I'm suppressing it. Like physically, I'm taking that stuff and throwing it in a basement because I don't have the time to use it. Right. And so, like, those are hobbies that I love. But I think there's something that I really want to do. And we were kind of talking about this, I think, before we started recording, but starting a podcast. Like, that's something that I genuinely want to do for myself, to talk to people that I want to talk about. Because the way that I look at, this is a thing too, like even with my content with trading, as much as I want to help people, it's all selfish, right? Like I know that trading publicly will make me a better trader, right? I think that that's like one of the things so many people don't understand is like, I do think that I would be worse of a trader if I did not have a community to hold me to a standard. Like
you're not accountable. Yeah.
100%. It's the same thing. It's the same reason why I've gained so much weight in the past year. I'm sure that if I had to do that publicly, right, that would have never happened. Like, so I think that when you're documenting things or when you're even doing it through the eyes of like, hey, I just want to become better at what I'm doing, it helps to have accountability there. And so one thing that I really do want to do is get back into, first of all, training in general, like lifting more, prioritizing that, prioritizing my health, get back into yoga, back into MMA, but also starting a podcast and just spending more time learning and traveling and like learning from other people, right? I feel like I've spent a lot of my life learning from books, but I want to speak to those people specifically.
Yeah. And the beauty is that you've built something that can afford you the freedom and the time to do that. And so, I think we have, I was talking to my wife my wife and I kind of came up with this. It's not unique to us, but at the time it was. We'd never heard anyone describe it this way. But in life, we tend to look at life as like years or months or whatever. But in reality, life's more like you have seasons. And a season might be a year and a half, might be 3 years, might be 5 years, might be a month. But you have these seasons of life. And there is a season for messing around, being stupid, being up all night, doing stupid things with your friends. And there is a season for really trying to limit the amount of fun, say no to this and that because you're just grinding, you're trying to do something. To your point, you have an opportunity in front of you and you can take it, or you can try to balance out the BS with that. And the truth is, you're not going to do either well. You'll disappoint the friends because you're not always able to hang out with them, but you're also going to disappoint yourself because you're not doing good in the thing, your job, your career, your podcast, whatever it is, your thing. And that's, to me, it's like between like your mid 20s, I would say, to maybe your mid 30s to end of your 30s, like that's your golden era to grind and really sacrifice the time, the fun, the weddings, the party, the bar, all that stuff. Like that's your time you only have a certain finite window in life where you have that. And if you have a golden opportunity in that window, I feel like you got to take it. But the beauty is, I think, and obviously I'm in it, right? I'm not there yet, but as you get towards the 40s, your 50s, your 60s, you get to reap the benefits of all that sacrifice. And I think that's really the whole point. So I kind of love that I would say you're far ahead of where, maybe not where your own goals, but in general of people who are in those seasons. Like you're going to be able to travel wherever you want, live remotely, and still do everything you're doing. It's the beauty of it, right? You can trade remotely, you can podcast remotely, you can, as long as you got an internet and a computer, you can do anything you want.
Yeah. And like I'm in this season of grinding right now. In my 20s, I was partying, playing music. Like, I was messing my life up, right? Ultimately ended up going well, but not going well in that season. And I think that's why, I think one of the hardest things about life, but one of the things you have to be the most cognizant about day to day, and this is where gratitude comes into play, is understanding that there's an expiration date on everything, right? Like even including your success. And so it's like when I look at like, oh, I've grown by X amount of followers, and it's like somebody else will take my place, right? And it's like, and there will be more people after you and more people before you. And like I looked up, and so that's why I don't ever get like attached to that, to like anything as far as like metrics of like, even if I were to get to like 1 million subs or something, like I wouldn't ever be attached to it because at some point it's going to go away. But I think that's also why I try to hammer into my students and I really share everything that I do, right? Like, because I'm not going to do this forever. Like I will at some point continue to share my trading, but not to the level that I'm doing right now. I'm not going to be putting out multiple videos each and every single day. I'm not going to be working one-on-one with people each and every single day. I'm not going to do this forever. I understand that there's probably like a total 4 to like 7 year window max where I could do this. And I'm on like year 4.5 right now. Right. So it's like the way that I think of it is like everything that I'm doing right now has to like be able to supersede me. Like when I'm done, like that people can take what I have and continue to use it in the future, because even everything that I'm trading right now, like it's not mine. It's the trading communities. Like my goal is to have people eventually use these. And that's why I see a lot of times people will message me like, hey dude, this account is like taking your trading style and making it their own. I'm like, whatever. Like, I don't like, it's not, you know what I mean? Like it doesn't matter. Like that is number one, how I know it works. Number two, like the point is to have it outlive you in your time in doing this.
I was gonna say if you didn't want that,
yeah,
and you're doing a really bad job of putting it out there for everyone in the world, YouTube to see.
100%. Yeah. And the way that I look at that too, because my business mentor, like he has a conniption all the time with me, because he's like, bro, you need to stop giving away everything for free. You need to stop, because like I do have paid aspects. It's just, here's everything in my style for free, and then what you pay for is the ability to just do it with me. Right. But you can do it on your own. Like, that's fine. And he's like, bro, you need to stop. Like all of these people are going to take your indicators, which once again, like, it's not like I created most of them on my own anyway. Like I took them from other open source networks. So there's no reason for me to like take something that's open source and close source it. Like that's grimy, you know? But Yeah, I mean, like he freaks out because he's like, you could be charging so much more, you could be doing so much more, you could make IP across all this, and I'm like, for what, dude? Like, I'm not, like I look at what I'm doing right now, and like I said, the goal is to do it for a couple more years. Always have my hand as far as investing and sharing what I'm doing, but definitely not to the level at which I am right now, and definitely not as frequently as I am right now.
Makes sense. I mean, your content isn't necessarily evergreen, but
Yeah,
your lessons are,
yeah,
right?
thank you.
And that's kind of the beauty of it. And yeah, I mean, I'll say this selfishly as obviously a Pete DiCarlo fan, and I'm sure everybody else who watches this and everyone who doesn't watch this will all say selfishly, we'll take you as long as you're
Yeah,
gonna be here. We'll
thank you.
keep it coming. We love the content, especially when it's around, I would say any of the Max 7 companies. It's definitely, there's something, I, I don't want to say like confirming, but it's like you get to hear someone else talk about the things that you think is happening. And you hear someone else who, I always tell people, listen to the ones who are right a lot and ignore the people who are wrong over and over again. It sounds so simple, but people don't do that. It's like all of a sudden they're like, it's like kind of like let your runners win or run, or let your winners run. It's like, but people are like, no, I made a little bit. Now I
Yeah,
got to go find the next thing. It's like sometimes that is the next thing,
yeah.
you know? And so listening to people who are right, I think is important, but there's a confirmation that helps when you kind of recite back to us, what you're seeing. And it, you know, maybe it shouldn't be this way. Maybe it should be this way. I don't know, but it helps that a vindication. Like, okay, I'm not crazy. Someone else who's right a lot, who's been very successful, they're seeing it this way too. Or I would also say probably frequently a lot for the test community. Okay, maybe I should be a little concerned here. Maybe I should think about what I'm doing. If I have these crazy options on, maybe I should think about, all right, time to get out. Like, I may just try to be logical here, or we're gonna have a pullback here. These 2 month out, $700 strike price,
Yeah,
not gonna happen.
yeah, yeah, yeah. And I,
um,
and I think, God,
no, you go.
I think too that the way that I look at my content is people need to be reminded more than they need to be taught. Right? What I'm
Yeah,
teaching is not necessarily like life changing. Right? It's like, I guess it's life changing if you apply it, but it's not like this crazy thing that you've never heard about, like risk management, position sizing. It's okay to lose. Here's how you win. Here's how I let my winners ride. Like, it's the same thing over and over and over again. But I think that what is comforting for a lot of people is seeing it play out in real time for years. Like for years, like, oh, he made a lot here and then he lost here, and but like he's doing it for years and for years and for years. And I think that also having this humility and understanding, which I think, like, I get my biggest amount of influx of customers and followers when I lose. Like, just when I lose, because it's like there's this, number one, like authenticity that people crave for on the internet. But number two, there is this, like, I think, relief that comes from a lot of people for somebody who is where they want to be to say it's okay to lose. Like, it's
yeah,
all right. It happens. Like, statistically, my win rate
it has
is
to happen.
60%, right? So it's like
Yeah,
I'm literally winning more than a coin toss. But it's about risk management. It's about your risk versus reward. How much are you making when your convictions are correct versus how much are you losing when you are wrong, which in doubt, you're always going to be wrong at some point. And so, yeah, I think that, like, as far as my content, that's kind of the void that it fills, even though it's kind of the same thing each and every single day over and over. Like, that's what trading is.
hmm,
Right. And my whole thing, and I've worked with like my mentor a lot, is like, you should do your thumbnails this way, and you should get like you should create these different formats for videos. I'm like, yeah, but that is what's going to drive content. That's not what trading is. Like, you know what I mean? Like,
yeah,
trading should be boring. Trading should be mechanical. Trading should be the way that I think I interpret it to be and that I show it to be. It shouldn't be hooks and, crazy flashy like content, and here's the cars with like that's great for content. That's not what I'm trying to do here. You know.
yeah.
So yeah, I'll continue to as long as I can. And like I said,
Good.
it's I will always the biggest thing is when I say like it's a season, I would just back up to making like 5-6 videos a month and focus more on like the next 6 to 12 month macro bull cycles and stuff like that.
Let's talk about zooming out and maybe kind of looking at a little bit of a bigger picture. You know, we're in a very interesting moment right now when it comes to the markets. You know, you've got, and I want to hear your take on a lot of this. Like, forget trading for a second. Let's just talk about the markets. So, you know, you have Michael Burry putting on shorts on Nvidia and Palantir, followed by closing up his shop right after CNBC kind of screwed up a $9 million position, says 900 million because they didn't understand how apparently options work, or they just put notional value. Yeah, exactly. Everyone's freaking out about AI bubble, but it kind of feels like deja vu to me when everyone's freaking out when the DeepSeek situation happens. Like, oh no, you know, the US is going to lose. And now it's like, oh no, there's overinvestment. And, you know, meanwhile, it seems to me like these companies still can't get enough NVIDIA chips. They're all still being used. They're all still investing in each other. But for some reason, once we had this kind of scare from Michael Burry, Sam Altman, CTO, comes out, talks about the US government might need a backstop these AIs. And, you know, I'm seeing a very binary almost, where I'm seeing Michael Burry, I think there's something weird happening there, especially after he closed out his fund. I almost feel like he was trying to get out of his stuff. His argument about the CapEx and depreciation cycle for the data centers, I don't think he understands how it's working and how there's this new longevity that you can get because there's these new workloads that can be done. I don't think he understands that. And just real high level, you know, GPUs used for training for 2 to 3 years can then be used for inference for another 2 to 3 years, can then replace CPUs that are being used rather than having GPUs, because at the end of the day, CPUs will eventually get displaced by. So there's a lot of things that can happen here. But the way I see it is you have companies like Meta who have a whole different profit generation arm that can help feed into their AI initiatives. Tesla, same thing with energy and autos, feed into it. Microsoft, same thing. Google, same thing. Amazon, same thing. The only companies, Apple, same thing. The only companies that really don't have that is an OpenAI, which is interesting, is an Anthropic, which is interesting. And so I don't disagree that there might be a bubble somewhere, but I don't think it's in these profit generating juggernauts that are going to be fine no matter what. The worst case scenario, hey, they had a bad investment, but they're still making money left and right. And so I'm curious what Pete DiCarlo's take is on it, on what's happening in the market. Is this all another DeepSeek scare? Is this a Michael Burry's trying to get out of his trade? Is this a real bubble? Is there something underlining that we don't see? I mean, like, what's your sentiment?
Yeah, so it's a lot to unpack. The first thing I would say is I am not a fundamental investor. So what I'm about to say, you know, take with a grain of salt, right? Like everything that I do is based off of technicals, which are very bullish right now from a macro standpoint. But yeah, I totally agree.
Real quick, you guys can go. Pete, maybe last week, did a video on the S&P and how the SPX is doing. So go check that out.
Yeah, if you want normally when we have these type of technical signals in monthly time frame, it's about an 11-month bull market rally on average. So sometimes it'll be a little more, sometimes it'll be less. And normally it's like a 30 to 40% run. So if you go off of those metrics alone, it'd be expecting the S&P to 500 to get to 800 by the end of next year, which means we're right now potentially halfway through that move max. Doesn't mean there's not corrections, like, you know, 5-6% corrections within that. But yeah, I mean, so going to like the OpenAI thing versus, you know, Mag 7 companies, like you said, like profit generation, like they're completely different things. You know, it wouldn't be surprising to me if OpenAI eventually becomes like an AOL, right? Where like AOL was like the shining star of America Online, right? But it's like they didn't have all of these other aspects that all the other companies that succeeded them after it actually had. And so you're right. Like when you look at something like OpenAI, like they are just burning cash flow. They're not, there's a lot of good things that they're doing, but I don't think that they really have like a lot of public appeal, you know? So I have no idea what's going to happen with that specifically. Now, when you look at the AI landscape and you look at like disruption and bubble and all this stuff, like, yes, there are pretty crazy valuations out there, right? Like even when you look at just from a PE standpoint, which in my opinion, I love the book. take intelligent investor, throw it in the trash, right? Like it's like, yeah, if you look at a stock like even like Tesla, I think PE right now is like 225. Like, yeah, from a PE ratio, like that's crazy, but it doesn't mean the stock isn't going to rally, right? And
Mhm.
that's the biggest thing I'll say, that why I don't care about fundamentals when I'm trading and I care about technicals is because even if something is fundamentally undervalued, does not mean that it's going to go up, right? Like the only way that the market goes up is a voting machine, is if there is an influx of buyers and not enough sellers and the market gets bid up. Very simple. Right now, the thesis of the fundamentals is what would entice buyers to get into a position. But if they're not building long-term positions and there's not more buyers and sellers, you'll get stuck in a value trap. Intel, which finally is doing pretty decently as of recent, was a value investor's nightmare, right? Like you would fundamentally look at that company for the past 3.5, 4 years and be like, wow, this is such a great company. PE is so low. Look at the financials, income statement, balance sheet, did nothing but underperformed. Right. So like that's why I put a wedge between fundamentals. And the other thing too is fundamentals, you can sip the Kool-Aid and you can fall in love. Right. Like, and that's the thing that I always say, and I try to like remain objective with like Tesla, the Tesla community is like, look at 2021 to 2024. The for those who are very deep into Tesla, the core business idea has not changed. It hasn't. It's just finally being implemented. So it's like if you fundamentally believed in the stock back then and you fundamentally believe in it today, there could have been multiple years where you just didn't make money. Right. Which is why I think that understanding the fundamentals of a company that you want to invest in, but also saying to yourself, oh, here is the monthly trigger to get into a position they're actually buying. Now I'm going to put my money on the table to play that potential breakout. Now, with AI and the AI bubble in general, yes, these valuations are very high, but the truth is nothing has really been implemented besides LLMs. Right? It's like if you look at everything that has happened in the past couple of years, it's just long language models. Like you're not even like even something like Tesla, like the robo taxi network hasn't even scaled. The ability to actually remove the safety assistant from the vehicle hasn't even happened yet. What does that look like? Right?
Yeah.
What do these AI agents eventually look like? Like I think that we are scratching the surface of AI implementation and what AI can do, because the only groundbreaking thing it's really done is long language models and displaced some jobs in the job force, like some very basic admin tasks. I think that as far as an implementation standpoint, we are at the very beginning of what can happen. Now, how does that reflect stock prices in the short term? I don't know, right? Like you have the market hates uncertainty and hates instability. And that's why obviously back in April and May, when basically tariff threats were going all over the place, that this idea that like we could slow down this AI super cycle by imposing tariffs and switching things up, like that freaked a lot of investors out. DeepSeek freaked a lot of investors out. Like you saw that was the
Yeah.
end of the world, Black Monday. No, it wasn't, So for me, like I'm still very, very bullish on this bull cycle and on AI. Does it mean that any of these companies are undervalued right now? No. Right? Like, does it mean I'd be starting a position today on Palantir? No. Right? But I do think that from a fundamental standpoint, we just scratched the surface right now of, and when you look at these big companies, they are all from a data center standpoint or an energy standpoint buying nuclear power plants. Like you can see that with their vision, we are just like 1/10 of the way there.
Yeah. No, I couldn't agree more. I mean, it's especially with your PE conversation.
Yeah.
It's just such a horrible metric for
Mhm.
any growth company, or let's just say any company that doesn't have a dividend. It's just a horrible, horrible metric. I
Yeah.
mean, and Netflix had a 1,000 PE at one point. It's like so what? You're going to tell me that you're not going to invest in them? They've just been juggernauts, right?
Yeah.
It's just not a good. Go
It
ahead.
was a great metric in a world where there was not infinite leverage. Right.
Yes.
So like before the dot-com bubble and before technology really became technology has always been a thing. At one point, oil was a technology, right? Like machines were a technology. But I'm talking about like internet, like pre-internet, it was good because you did not have the ability to infinitely scale anything. There was no infinite leverage. But when you're working in this world of infinite leverage that can happen overnight, PE ratios, in my opinion, just don't matter. Like when you look at something like Tesla, right? Why is it trading at such a high PE? Right. Well, there are a multitude of reasons. Number one is because if they just could get to the point where they press a button and every single car in their fleet across the entire country that is capable for it can be used as a robo-taxi, their ability to scale that aspect of their company is insane. The sheer amount of revenue that would be generated, the sheer how quick they could build all of that out, it's massive. I mean, even look at a company that's not public and is burning money like OpenAI. How fast has OpenAI taken over the world? You know, and not even just the world, like all these other companies weren't working on AI and long language models from what, at least my understanding. Like Meta wasn't building theirs off of Llama, like Claude wasn't necessarily a thing. Like all these other companies, like as soon as they saw that, they said, how can we pivot as fast as we humanly can into this? And we live in a world right now because of infinite leverage where you can pivot very quickly. And this is what's going to cause very high PE ratios, because we do live in a world of infinite leverage where you can grow your revenue exponentially and you can grow your profitability exponentially in a very short amount of time.
Yeah.
But prior to that, it wasn't, you couldn't do that. You couldn't be like, let's just print Procter and Gamble, like paper towels or whatever into like oblivion. Like you can, like, you can't do that. And margins, right? Like there's only for physical products and stuff, like there's only so high you can make your margins. When you're dealing in like digital products and cloud products and all this stuff, like you can, your margins are crazy.
Yeah, you're absolutely right. Meta definitely pivoted from the metaverse to LLMs real quick.
Yeah.
Right. And I think that's kind of a little bit of the fear with the AI bubble, is that people fear that it's a metaverse bubble again, but it's not. It's, to your point, it's very clear where we're just scratching the surface, like you said. You know, it's when you look at like the actual usefulness and the tools that are out there, you can tell that it's real because you can, as an individual, interface with it and see the value of it. And all these companies are putting all this capital behind making things better, advancing it, and it's just beyond clear that this is going to be something big. It's not just going to be a metaverse, right?
Yep.
But you did mention leverage, which is interesting because you're right. There is a lot of leverage out there now, whether it's certain ETFs, whether it's options, whether it's margin. Right now, we are notionally at least at a record amount of margin ever. Now, does that mean anything? Because the stock market's also bigger than it's ever been. But do you have any... Does that raise your eyebrows at all? I mean, I know when you're trading, you're essentially just looking at, you know, what are the technicals doing? How is the market moving? But is there anything in the back of your mind saying like, all right, this is getting a little dicey. Everyone and their mother's got, you know, margin on their brokerage account. Like this doesn't smell right.
Yeah, I mean that, and even the American consumer. Like the American consumer is not in a good spot right now, right? Like you see like defaults on payments for mortgages, defaults on payments for cars. The price of everything is not necessarily dropping significantly as it is. So I think that this is another thing where I look at AI and everything that we just talked about. Like I think we're scratching the surface, but when I look at the American consumer, I'm like, it doesn't look hot right now. Quantitative easing will hopefully help a lot of that, but like to what degree? But yeah, I mean, I think that the biggest thing that you have to separate as well is the retail investor and the overall institutional side of things, right? Because obviously the institutional side of things is what drives and moves the market. But I do think that when it comes to retail investors, yes, there's a lot of margin. Yes, there's a lot of leverage. Yes, I've seen people with complete horror stories, and that does worry me. But once again, in most cases, they're not going to be the ones driving the market. They're normally going to be the ones catching the top, you know, unfortunately. And, you know, that is something that does worry me. And that's the thing too, like why I always say, like, even with retail investors and margin and leverage, it's like, you have to be careful because These institutions can afford to lose money. These institutions can deal with these significant pullbacks. But if you're leveraged to the gills trading options and the market pulls back 5%, that's nothing. That's nothing. You know what I mean? Like what has happened in the past 2 weeks, everyone's from what I've seen is like so worried. It's like, dude, that's nothing.
Yeah.
Like it's literally nothing of what could go wrong. And like within my models and within my past performance, my average max drawdown is like 35%. So when I'm looking at my returns
On a trade or on your portfolio?
No, on the full portfolio. Now, the thing is, like, max drawdown doesn't mean that I opened the fund and I lost 35%. It means from very high to very bottom. So let's say Tesla goes up 100% and then it drops 30% from that high. That's still a 30% drawdown. But here's the thing. First of all, that's fine. That's normal. I'm okay with that. But if you're using margin, that goes from a 30% drop to, if you're using 100% margin, to a 60+% drop.
Yeah.
Right. So it's like the downside compounds pretty significantly. And which for a lot of people, if you're not constantly putting money into the market each and every single month, then when that drawdown happens, you are going to be in a pretty crappy predicament, because most of the time your broker is going to margin call you, which they're going to sell your positions even if you don't want to. So in my opinion, I think that there are times where I will pull a small amount of margin, but it's only because I predominantly trade shares. And my thought is like, if my max drawdowns historically are 35% and I were to go use 25% margin, then I'd pull it down to like 40, 45%. I'm fine with that. But I think like for 99% of people, they should not trade with margin. And I do think that the sheer amount of leverage that the American consumer is living off of right now is not healthy, but also what else are you going to do? Like leverage is, I love talking about leverage, right? Like, because the idea of infinite leverage, it has gotten me everything that I want, in my life. Naval Ravikant, if you ever listened to his dude, so his tweet storm, he did this, I think back in like 2021, but he does an entire podcast. It's like 3.5 hours across this tweet storm. It's called How to Get Rich Without Getting Lucky. Changed my life, dude. I listen to this podcast at least once a month. Like it's that important. Like it really is. I would listen to it monthly.
How to Get Rich Without
Getting Lucky. Without Getting Lucky by Naval, Naval Ravikant. It's life changing. Okay. And it's very simple, but it's life changing. Yeah. And the biggest thing that he talks about is infinite leverage. And so this is like one of the main things that I've also put into my trading and helps me so much, is that like when I look at my trading and I look at my investing, I'm not looking for high win rates, right? Like in life, what you're looking for is outsized returns. That doesn't even just mean as far as an investing standpoint. Like when you look at creating content or creating a podcast or creating some sort of product, if you create the product and it ends up going nowhere, what did you risk for it? Very little in most cases, right? This is why when people hear leverage, like, I'm going to refi my mortgage and then take that. It's like, no, now you're risking your house. You're risking what he calls catastrophic failure, right? So you never want to risk your health. You never want to risk where you're living. You never want to risk like your core ability to basically stay in the game forever. But what you're looking for in life is outsized returns. And this is why for me, like risk versus reward, and what we said going all the way back to the beginning of this, holding on to your winners as long as you humanly can, that is what's life-changing, right? Like of the 5.5 million that I've made in the past 4 years, 1.8 of it came from Tesla last November. And it's not because I was over leveraged to the gills. It's because that one time that my requirements were met and the stock ran 140 something percent within that quarter window was enough to make years of my hard work happen. If you look at Palantir, right? Like, and you go to a monthly chart and you put the BX trender up, you will see that the stock is up literally for the past, I think it's like 20 months. It has just been showing
green,
nothing.
right?
Yeah. And now imagine if you held it, right? Like imagine now, of course, here's the most important thing. You're never going to sell at the perfect time. This is the thing that I try to explain to everybody is like, you're never going to sell at the perfect time. So don't try to. There's just really no reason to. But if you look at these types of stock, even Nvidia, right? Even Bitcoin just came off of a 259% rally over like a 24-month period. If you would have just held until we saw the trigger to go long and until we saw the trigger to get out, you would have made it 250% unleveraged on shares alone, just holding Bitcoin by itself in the past 2 years. And that's what you want in life, is you want these bets where even if there's a small chance of it happening, you are risking so little to make so much that when you play that out over the long term, you will make a killing, right? And the problem is people
do the opposite.
Yeah, yeah. And it's like patience is a hard thing, right? Like it's very hard to be patient, but people just want it now. And so what I've noticed as far as trading is that statistics and probabilities get me going, right? Like in a good way, because it
Hey, I'm an
literally,
options guy, so
dude,
yeah.
yeah. And it literally is the exact opposite of human nature, right? So it's like when I'll run like a back test and I'll show it like within my videos, right? You'll look and you'll say to yourself, okay, if you ran this very simple strategy of going long when the BX trend turns green and getting out when it turns red, over the past 10 years, you would make a 1,000 something percent return, right? Everyone sees that. They see those numbers, they see those statistics, and they say to themselves, I want this. I will follow this. This is no problem. This is amazing. This is great. But what they don't see is the sequence of each one of those trades and how they played out, right? Because it's like, if you have a 60% win rate with a 5-to-1 RVR, you could lose 5 times in a row. Like statistically, that's not impossible. Now that might mean if you're trading off of a monthly time frame that you didn't make money for years. Now this is just if you're trading one stock, right? Like I'm constantly trading about 40 within my ETF. But it's like, how many people would continue to do that? How many people would not see success for a year? How many people would not see success for multiple trades and continue to do something, right? It's very, very little. And so I think that there becomes this like disproportionate understanding when people are looking at returns or back testing and all of this, where they think to themselves, I want the end result, but can you live with what the process looks like, actually looks like, what it feels like, right? Because like I said before, 30% drawdown is wouldn't surprise me. It's normal to me. And when you look at my returns in the past couple of years, you'd say, I'll deal with a 30% drawdown. No problem, bro. Like I'm good with that until it happens. Right? Because then you start questioning, then you start poking the bear, then you start saying, well, does the system actually work? Did I just get lucky? This time is different? This is the AI bubble, right? Like this time's different. This is the China tariffs. This is coronavirus. This is inflation, stagflation. And it's like, this is why you whip these narratives up in your mind, which once again, it's all based off of fundamentals, but you whip these narratives into this time could be different.
Yeah.
And I think that, in life, not just in trading, you need to be looking at outsized returns for the efforts that you have.
It's funny you say that. As far as like people, it's easy to follow this process, this is your end result, right? Even if we know 100% is going to work, meaning like let's take something not trading, stick to this diet, work out like this, eat in a calorie deficit versus calorie surplus, you'll get six-pack. We know that. It's very easy. It doesn't matter what you do. It's very simple, but people still struggle to do that because, well, it's hard, right? It's the 30% drawdown is oh man, my friends are having a party and they ordering this pizza and like, all right, well, one slice isn't going to hurt me, right? And it's like, okay, well, it's that one time we're like, all right, let's just take this loss and let's just get out of this, like it's freaked me out. It's hard. It's harder said than done, but consistency is the biggest thing with anything in life. And I think, going back to statistics, you have to give the statistics a chance to play out. You have to. You need enough occurrences to let the statistics play out, and they will. Right? If I flip a coin once and it goes, hey, it's not 50-50, well, not true. If I flip it again, it's heads again, it's not 50-50, not true. You didn't give enough occurrences. But I had something written here, something I want to bring up, something that I think I try to channel this a lot to people I talk to, especially in test community or just people who follow me, and I talk to them about how I trade, and I think you kind of adopt a little bit of, or I don't want to say you adopt it, but I want to say that you have the same philosophy, and that philosophy is I don't know anything. I don't know what's going to happen. You can tell me that the Fed's absolutely going to cut in December. I won't know how to play that. I have no idea. The market might sell off, might go up. Tesla had, horrible earnings so many times, and the market goes up instead of down. I have no idea. You could tell me the news ahead of time. I don't know what to do. The only thing I know is how to place a trade based on my mechanics and how to get out based on my mechanics, whether it's for a profit or a loss. I know how to ring the register. I know when to take the loss to your point, risk mitigate. But I think, again, you say that to someone, and the same thing like you're saying, it's easy to hear. It's easy. Okay, yeah, you're right. All I have to do is I don't know anything. If I do these things, I just got to listen to my rules, my mechanics. But then you quickly find people just break it. They break their own rules. They break their own mechanics. They don't stay disciplined. And I'm just curious, how do you within your community help people adopt that sense of you don't know what's going to happen. You just got to
Yeah.
take what the market gives you. And then based on your rules, you have to make sure, like I'm always on a soapbox, constantly telling people, I could tell you the perfect entry for every trade based on my system. Hell, I could do it for Pete DiCarlo's system. I could tell you exactly what he looks for to get into it. I could tell you the BX, the 1 day, the weekly, the monthly, especially if it's all lining up. Look at general market structure. I could tell you this all day. But you know what I can't teach you? And that you have to, has to come from within, is how to be disciplined when shit hits the fan. When all of a sudden that the rules you had break down, and now you have to default to your mechanical rules on how to risk mitigate, how to get out of a trade and take that damn loss so you don't take a bigger loss and wipe yourself out. Even if it means that we keep going up.
Yeah.
You have to be, so how do you within your community help them, I don't know, get over that barrier? Because again, I know I'm saying it and it sounds so easy. Everyone's going to listen to us, be like, this is the dumbest thing. Move on from this, Nick. Get to talking about Tesla. But this is like, to me, so fundamental. It's the thing that everyone screws up.
It's the single most important thing, because you could have the best strategy in the world, and if you just don't play it, it doesn't matter, right? It's like, even people, I'll definitely talk to you about like how I help the community, but I look at my trading as professional gambling. And people hate the idea that trading is gambling, but it is, right? It's like, if you know how to play blackjack statistically to the point where you have an edge, right? If you start to go on a run, are you going to increase your hand size? Like, no. So one of the things that I notice so much about like professional gambling is there's a reason that the house imposes max hands and min hands, right? It's because your power is in playing your statistical edge to perfection and using proper position sizing. And if proper position sizing wasn't a lever in the actual side of the player, they wouldn't have maximum hand sizes. They wouldn't have minimum hand sizes. They would allow you to do whatever you want. But it's because of that they want to control your ability to bet and control your ability to actually manage your risk. And so the same thing comes into it with trading, where you could have a statistical sound strategy that will perform well over hundreds of trades and thousands of trades. But once again, if you don't actually allow it to play out because you're over risking for everything, then you're going to end up, first and foremost, just not actually making it long term, because you're always going to hit some sort of roadblock. You're always going to hit a multi losses in a row and a losing streak, and then you're going to blow up. I think the biggest thing that I try to instill in my students more than anything, and it's why I don't even try to use the word traders anymore. Like, even though like the community's traders helping traders, you're a fund manager for yourself, right? And I think that the first thing, first and foremost, is that you should never be trading with money that you plan to use anytime soon, right? Because number one, it's just not safe, because the market's going to pull back at some point. If you're saving for a house and you've got 50K for a down deposit and you want to start trading with it, don't. Just don't. Like, because you're too attached to that money, first and foremost. And two, you're going to need to pull from it sometime soon. So when a drawdown initially happens, and eventually is going to happen, you're not going to be able to cope with it. You're not going to be able to stick with it. The second thing is that you should be looking at this, like I always say, like as a retirement. Like, this is your wealth building machine. 98% of my community does not trade full time. There is no need to trade full time, right? All these people have jobs. They all have things outside of their life that are producing money, but this is a way to get leverage into their corner. Because no matter what you're doing, even if you're a lawyer and making $400K a year, your earnings potential at some point is capped, right? And so when we talk about infinite leverage, how can you get more leverage? Well, you can start your own fund, you can manage your own ETF, you can follow a specific strategy, and you can get some sort of leverage back into your corner. Now, I think the hardest thing for most people is, and this is like from a psychological standpoint so hard, is like I look at all of the money that I have in my trading accounts as dead money. Like I fully 100% know, because I have a lot of mentors who are older than me that lost 60, 70, 80% of their net worth in dot-com bubble, lost 60, 70, 80% of their net worth. Most of them went bankrupt and got divorced in the '08 financial crisis. Like I know that it's not going to happen to me, bro. Who knows? Like I have no idea. Right. And so it's like, even though I have, and this is a blessing, right? In its own right. Like I have not upgraded my living at all in the past 5 years. Like I live in the same house I bought for $200,000 back in 2020. I drive a car, like I have a Cybertruck, but it's nothing crazy. I don't have a Rolex. I got like a micro brand watch. Like I am in there's no threat to my life if my investments don't go the way that I want them to. So it's like, I think the problem is for a lot of people, they're just too invested mentally into the money that they are trading. Now, the way you get over that, right? And this is unfortunately why my higher net worth students do better, because they're not as attached to it, right? If they're making 300-400K a year and they're living off of 110K and their portfolio goes down 20-30%, oh no, it's not the end of the world, right? But if it's everything you have, then it's completely different. So the first thing that I try to say is to, number one, not be attached to that capital. And if you really need that capital to live right now, don't trade with it. It doesn't mean you don't learn how to, because at some point, like I wasn't trading with as much size as I am now as I was back in the day. So you have to learn how to manage money. You have to learn how to actually flex that muscle of discipline and patience and all of that. But I think that a big portion of it comes from, how do we reduce the need to be right or the need to be profitable today? We expand the horizon by zooming out, right? I'm not going to be able to remember it at all, but I was listening to this podcast basically where they were explaining the plot of land in New York that the colonizers bought from the Indians for the actual plot of land. Like how, if you look at it today, how screwed it was. I think they got like 10 cents or $10 or something from that. And like what New York is worth today. But if somebody would have managed the money, right? Like we're talking super, what if here, but managed the money on that and got a 10% return for the past 305, whatever years it was since that happened, they would actually have more money than what New York itself is worth today. I think it's 2 to 3 times, because you're broadening out your time horizon. Right. And so I think the biggest thing I try to explain to my students, and the one thing that they do so well, is understanding that like the only reason you're here is if you plan to do this for the next 20 years. Right. And I think that one of the things that specifically my business mentor has helped a lot is saying, you have to know who to say you can't help. Right. Like you have to know that like when I was driving DoorDash and I was making $1,500 a month and I could barely pay my bills, like I can't help that guy right now. You know what I mean? Because even if I fell into $20,000-$30,000, if that's all that I have, I'm not going to be able to treat that money in that way. Right. And because the thing too is like, and this is like the thing that I think it's even harder that I try to push to my students, is that the feeling that you have of these drawdowns, because a big aspect too is repetition. Right. So the hardest thing is the longer that you do this, the easier all of this becomes. Because if you're brand new to trading and you experience a 30-40% drawdown, your doubt that creeps into your mind it's not a whisper, it's a scream. It's like, dude, 90% of people fail doing this. Why the hell would I be able to do this? You're not special. You don't know what you're doing. You need to just get that money back. If I could just get back to zero, if I could get back to break even, I swear I'll never trade again. Right? Like once you live through 2 of those and you make your money back, and then you live through 3 of those and then you make your money back, and then you make even more, and then you live through 4 of those, you realize this is just what it is. Right. Like I haven't lived through an '08 financial crisis or a dot-com bubble, but like I've lived through multiple significant drawdowns in my portfolio. And so when there's a drawdown in my portfolio, I'm not worried. And I notice for my students, the ones who've been with me for 4+ years, they already understand that. They already know. they're completely fine with it. But the problem is, how do you get somebody who's starting to be able to stick with it when
Yeah.
that happens? And I think that a lot of it is, which is very hard, disassociating from that money today, because it doesn't matter how much you have today. The goal is the compounding over the long term, right? Like if you're in your 30s and you're trading today with a fund that's even $50,000, it doesn't matter how much it is, right? It's always the percentage and what that can and will eventually grow to in the future. You're not trading. It's like we were talking about earlier with seasons, right? It's like, if I put all this work in now, then in the future, I'll have a season where I can travel and I can work from anywhere, and I can put one video out and it'll get 100,000 views versus I got to put 10 videos out and I barely get 100 views. Like the compounding, the leverage from that season prior is what you're doing it for. All the success that I am seeing in my life today is coming from what I did 6-7 years ago, even from a content standpoint, you know? So it's like, imagine if when I was starting YouTube or starting X or starting trading, if I only based my success off of what I was seeing then, I would have never stuck with it. And that's why most people don't stick with most things, you know, let alone trading, like, because they're basing everything off of the results they're seeing that day, as opposed to saying, okay, well, 60% on 50K isn't much. If I could make that in a year, it's not going to change my life. That's not the point. Right? Yeah. Like that's not the point. The point isn't to take the 50K that you have and then cash it out and pay the government half and then live off the rest. Like that's not the point. You know, like the point is, and the other thing I noticed too, and this is why I tell 99% of people, right? Especially if you're not trading with a lot of money, not financial advice. I'm not, you know, but
never is.
I personally would max my Roth IRA and I would trade everything through retirements, because what I notice is my students who trade predominantly through retirement accounts do way better because they can't touch it anyway. They're not planning to touch it anyway. But when you have a liquid broker account under your personal name and you're like, oh, I did well today, I'm going to buy myself a new PS5, and you wire yourself the money, like, bro, that's not good, right? Like you're already attaching yourself to this money today. And so what I would say is think of it as, how would I operate this fund if I cannot touch it for 30 years? And that's why I think that trading under some sort of retirement account, and at least personally maxing, like I can't do it anymore because I make too much, but maxing your Roth IRA, maxing your 401k and trading it yourself, maxing your HRA, like doing these things is so important because it literally puts the shackles on you that you can't really touch it unless you want to get killed in taxes for a very long time. Plus you have the tax benefit, which is huge. And then if you end up getting to a point where you're trading real size, then open up a C corporation and, you know, trade through like a corporate broker or something like that. But yeah, dude, that's the hardest thing to get across. And, you know, I have a lot of students when they experience drawdowns and like, dude, this sucks. Like, bro, my account was up. Like I was at 500K last month. Now I'm at 450K and get used to it. Yeah. But it's like, get used to it, dude. You know, like for me, like I said, a 30% drawdown is normal, but like 30% on 50K versus 30% on 5 million, it sucks, dude. Like like you are only ever going to deal with drawdown, and the goal is for your account to only ever get bigger, which means that the numerical drawdown is only ever going to get worse. Like, you know what I mean? Like if you're trading with 10 million and then it goes down to 6 million, most people listening to this right now would be like, boo hoo. Oh no, I only have 6 million. Feel that. It doesn't feel good. Yeah. Like, you know, it feels terrible.
Well, people get too caught up in what their portfolio's all-time high is.
Yeah.
And they think like that's not your true portfolio. Neither 100%. Is whatever, you know, if April when we had, you know, big sell-off, you know, 2%, 3%, 4% down back to back on days on the S&P, you know, like that's also not real. You know, it's like the truth is somewhere in the middle. But people get so locked into that all-time high value in their brokerage.
And think about it too, from the standpoint of how these huge institutions and hedge funds, why do they have a statistical higher chance of making money long-term, right? It's because they don't have an attachment to the money. First of all, it's not their money. Most of the time they're trading pensions, they're trading clients' money. So number one, it's not their money. Treat it like it's not your money, right? Second of all, they're not getting paid from the performance of that fund, right? If you have an investment bank and you got $78 billion under management, your paycheck, the guys who are in charge of actually running that fund, their paycheck is not getting cut from the fund. It's getting cut from the company who is managing the fund, right? So it's like, if the fund grew double, they're not, I'm going to pull more money out. Like, that's not how that happens, right? It's like, it's treated very much so like a business. And so I think the problem is when you don't have these mental parameters or these mental shackles in your mind starts going to these different places. And I am no better than that, right? Like, I'm no better than that. Like, if I have a drawdown, like, I'm sitting here, right? And I constantly think to myself, I'm like, man, I should just go buy the mansion I want. Like, I should just go, like whatever. Like, the mortgage is ridiculous. And then I'll have a drawdown of like $1 million. And I'll think to myself, even though I know it's wrong, I'm like, bro, you're sitting here worried. Like you're sitting here thinking to yourself, like, I was looking at a watch a couple of weeks ago, right? I was looking at a Submariner, and I don't need a Rolex at all. But sometimes I'm like, you deserve it a little, like you've done a lot. And I'm thinking about it, and I'm contacting the dealer that I know. And then I'm like, there's no reason. There's no reason for it. And then, like, I'll think about it the next night, and I'm like, it'd be really cool. Like, dude, you wanted to get one by the time you're 40, you're 37, you're doing 3 years. Like, you've made more than enough. Like, you're fine. And then I just don't do it because I'm like, it's not going to make me happy. It's not going to make me more successful. I'm just going to get stabbed. Like, if I go to like a city or something, someone's going to try to rob me. Like, I don't need it. And then I'll lose like 80 grand in a day. And I'm like, should have got the watch. Yeah. But I'm like, you're sitting here with this mental turmoil of like buying this watch. You just lost 80K in a day. But then I have to stop myself and be like, you didn't lose that watch today.
Yeah.
When you zoom out and you look at this in 15 years, you will not even remember the drawdown. It won't matter. And that's why, like, it's so hard, but like, acceptance is the name of the game, because the same problems that you're going through as a small trader is the same problems you're going to go through as a big trader. Just bigger numbers, more pressure, right? Because now you have a lifestyle that you have to uphold, right? Like, and I think that that's been the biggest thing for me too, personally, has not been inflating my lifestyle, because I could lose everything tomorrow and I'm fine. But if I started inflating it, it'd be different psychologically.
Do you think everyone can trade?
No.
Okay.
I think. Go ahead.
No, you go. Linger on that.
I think that it's a loaded question because mechanically everyone can trade, right? Like, if I give you a system, it's the same thing with like, do you think everyone can have a 6-pack? Yeah. Mm-hmm. Scientifically, right? But there's so much more than just the science of calories in, calories out, follow this, do that. Like, if I handed you a portfolio, like if I handed you a playbook that was like, here's our exact entry requirements, which I do, right? Here's our exact exit requirements. Here's exactly how I would use my position sizing. Here's exactly how I would scale. Here's exactly what I would do. If you could follow that, you would be successful. Yeah. And therefore, yes, everybody could be a successful trader. But the real skill is, can you follow a system for an extended period of time without seeing results that you want to see, or without seeing them as fast as you want to see, or with dealing with these problems? That's where I don't think a lot of people can. So
what are the traits you've seen, maybe personality wise or temperament, or what have you seen from people who can be successful at this?
So I always say,
common denominator?
I always say that who you are outside of the market is who you're going to be inside of the market. One of the things that I've seen from a lot of people is the ability to deal with loss, like not just trading, but like loss in life, right? It's very odd, but I think that a lot of people who have been broken in their life, like in the past, and have dealt with a lot of loss, are people that do very well in the market. People who have seen a lot of success in their life don't do well. It's very odd, because there are a lot of times where I'll have lawyers or doctors or anesthesiologists and all these people who have been successful outside of the market, and they think that that's going to come over into the market, and it doesn't, right? Because the market, you are playing its game. You can't work harder to make the market move. Like you can't put more hours in to make the market move. You can't use your status or your prestige to make the market move. You literally can't do anything besides just sit in a position and hope that what you think is going to happen is going to happen. And so what I notice is there are a lot of people where like they have not really experienced a lot of loss in their life, and success, I don't want to say has easily come to them because they've definitely worked for it, but where they just can't deal with eating shit and smiling. Like I forget who said the quote, but I basically twisted it and put it on X. But the original quote was like, entrepreneurship is like eating glass. You eventually learn to love the taste of your own blood.
Elon.
Yeah.
Not taste your own blood. No, he says it's chewing glass and looking to the abyss. And
basically like that. And I said with trading that trading, like good trading, is chewing glass and learning to like the taste of your own blood. And so it's like you have to be okay with experiencing losses, and you have to be okay with experiencing failure and messing up. And so I will say that a lot of times people who have experienced losses or failure in their life are normally people who actually do pretty well. A book that I want to read or write is called Learning to Lose. And I want to talk about like the correlation between that, like learning how to lose people, learning how to lose trades, learning how to lose business. And I think that's why a lot of entrepreneurs actually become really good traders, because it's the same path. Right? A lot of my best students, they are entrepreneurs, even if they own like a laundry machine, or we have a guy who owns a candy shop. Like they're just people who have like tried, taken a step back, having 2 steps forward, taking a step back, having 2 steps forward, because that's what trading is. Like, here's a problem, here's an issue.
Yeah.
How am I going to deal with it? How am I going to move on to it? The next thing too is patience. So a lot of my students, so the thing that I'm the most proud of in my entire life is that the churn rate, so basically the amount of students who leave our community each and every single year, is 5.5%. Wow. Which is crazy. Like that's nuts. That is, and I don't even know if they're leaving for negative reasons. They might be, or they might just be like, hey, you've helped me enough, I'm done. Because theoretically you can do it on your own. But our average member is between ages 35 to 65. Right? So these are also people who are a bit older, And so I think that patience is obviously a character trait, but I think that character trait also comes with age, right? Because that also comes off of, like I said before, learning how to go through losses in life, learning how to eat shit for an extensive period of time and being okay with it. And the thing is, I don't know how you teach that because you can't. Like you have to just kind of go through it. Like Alex Hormozy talks about like the Rocky moment and how people think that like montage of like going through it and not trusting yourself and not thinking that you think that that's minutes. And it's like, that is years. Yeah. It's years, dude. And most people just can't stick with it. And I get it. I said last time I was on the podcast with you that in the beginning stages of my career, if I had the ability to go get a job and make 6 figures, 200,000 a year, I probably would have done that. And I probably wouldn't have eaten shit the entire time that I was trying to make my business and my trading and my life work. And I wouldn't be where I am right now, because I could have just taken that opportunity, which was a much better opportunity at the time. But for someone like me, I just had to make it work.
Yeah.
That there was no other option. And so I would say that discipline and, patience obviously are the most important things. And I think the only way that you can get them is by going through life, or, and this is where it's going to get woo-woo, meditation, yoga, taking care of your body, putting yourself through hard shit every day. Like if you don't want to deal with generational trauma, or you don't want to deal with going through a divorce, or you don't want to deal with losing everything multiple times in your life, which I have, right? If you don't want to go through all of those things, then the only way that you can simulate that is by forcing yourself to do stuff that you don't want to do each and every single day, because that is going to build somebody who has not just discipline, but I'm trying to think of the right word, but like the ability to do something that they don't want to do and see results that they don't want to see for an extensive period of time, but still show up and do it anyway. And in my opinion, that is discipline, right? Discipline doesn't mean that I wake up and I want to go to the gym, so I go to the gym. Discipline is I wake up, it's 30 degrees. The last thing I want to do is I go to the gym. But like we said earlier, I do it anyway. It's the same thing with my emotions and trading. I'll wake up, I'll look at my portfolio. Whew, today's a bad day. I do nothing about it. Right. And it builds resiliency. I think resiliency is the word that I'm trying to think of. And so I think the way that you can do that outside is by reading Stoic books and learning Stoic philosophy and forcing yourself to do things that you really don't want to do. You know, like ice baths and saunas. I don't care about the health benefit. Like whatever. Like it just sucks. And the more stuff that I do that I don't want to do, the easier my life becomes.
Yeah, you have to. I always say you have to do something hard every day. Something when I say, I mean something hard is the wrong word. Something that really sucks.
Mhm.
You have to do something that really sucks every day. And to your point, back to the Rocky moment. Everybody wants a six pack, but they get beaten down on themselves, or they want to be rich and they get beaten down. So, something I'm constantly telling people is, you're not going to get strong until you felt weak a million times, going to the gym, leaving the gym, failing on that rep, muscle or sore. You're not going to make a lot of money until you have either, if you're trading or investing, had bad trades, had bad investments. You're not going to, everything in life, like you don't succeed until you failed a bunch, but that's the life. It's that juxtaposition between you fail until you succeed. You go to the gym, you feel sore, you feel weak until one day you're like, I'm strong. It's, you just got to get in there. And I always say, like, you have to do something that really sucks every day. That's why I like doing workouts like CrossFit or things like ice baths, is because you self-manufacture something that really sucks every single day. And you have to wake up, get up, and decide to go do that thing that really sucks. But it's good for you at the end of the day. It shows that you can do hard things that really suck and just get through it. And going back to trading, when you see a trade that's just not going your way, or, things aren't going well, wake up and say, good, I get to learn. I get to get better. I haven't seen this yet. Let's go see what we can do and how we can make it successful.
Yeah. And it's also like Hormozy says this a lot, but you said like it's hard. It's like, that's what hard feels like. Like, that's what I tell my students. Like, oh, this sucks. This is why 90% of people fail, because they give up right now. And what I try to do, and it's just like not my favorite. My students don't love it. When we're hitting all-time highs, I will be the seed in the back of their brain. I'm like, you're not as good as you think you are. You're not. Yeah. You're not a superstar trader. You're not as good as you think you are. You're not going to sell at the perfect time. There's going to be times in a couple of months where you're sitting here and you feel like you've lost so much, and like you're never as good as you think you are, and you're never as bad as you think you are. And I think that that's the other thing that you have to have, especially for me, flex that gratitude muscle of like understanding, like, it's never going to be as bad as it is. It's never going to be as good as it is. Both of them will not last forever. And I think that it's so important to do that. And I think the other thing that's so important too is I always say to myself, like, why do you think it should be easy? Right? I always say to myself, like, are you that egotistical, Peter, that you think that it should be easy for you when everyone else who came before you had to deal with the same things that you're dealing with, if not worse? Like, why do you think it should be easy? Like, it shouldn't. Like, you're and this is what, whenever I give advice or talk about something, it's just what I say to myself, right? Like, even my Twitter, it's me talking to me, even through my analysis, right? It's like, this is why 90% of people fail. And if you can do the opposite of everyone else, you will get the opposite result of everybody else, which is the result that you want. And I think the biggest thing that has, and it's going to sound egotistical, but like the biggest thing that has given me the life that I've always dreamed of and always wanted is by literally not taking advice from other people. Like, taking advice from only people that I want to have their, like, if I'm taking relationship advice, I want relationship advice from somebody where I want their relationship. I want their marriage. I want their family life. I want their business. I would trade places with that person, because 90%, your average individual is unfortunately fat, sick, and broke. So why am I going to do what the average person is doing? Why am I going to operate the way that the average person is operating? And I wish it wasn't that way, right? But the truth is, if you want to do, like I always explain to my students, like there's a 90% chance that a trader will fail. Okay. Let's decompartmentalize that a bit. And I don't know if we did this last time on the pod, but
We didn't.
maybe we didn't. Okay. So let's decompartmentalize this, right? Statistically, you have a 90% chance that you're going to fail. Well, what is a trader? It is simply a person who opens up a broker. That's it. There's no degree. There's no college. There's no minimum amount of hours, 200 hours, 1,000 hours to get accredited. There's nothing. You just open up a bank account and you put money in it. All right. So the first thing is, like, how many brokers are there just for Robinhood, right? Like, it's insane, right? So the first thing you have to understand with that 90% statistic is that you have a huge sample size of people, right? If they said you had to go to school for 10 years and then that's considered a trader, you'd have a much smaller sample size and maybe those would change a bit. So the first thing is you have a huge sample size of all of these people. The second thing is, what do the 90% of those people do, or do those 90% of people don't do, right? The first thing is that 90% of people do not have a long-term outlook. They do not, when they open that broker account, they're not thinking, how much money will I have when I retire? How much money will I have in 20 years? How much money will I have in 10 years? They're worried, oh, the stock's going up. Oh, the stock's going down. Look, and they start drawing these correlations. I made $50 in an hour today. I don't make that at my job. I'm going to be a full-time trader one day. Like, that's what the 90% of people do, right? So if you first of all step into it and have a longer term horizon, you don't care about what's going to happen today, what's going to happen tomorrow. You just care about sticking to your system and doing that over the long term, right? You're already better off than the 90% of people. Okay. How many of the 90% of people, and this is the thing, Nick, is going to like freak you out. How many of those people have a system? Okay. Oh. I have ran polls where 80+% of the people responding to the poll said they don't have a reason to enter a trade. Like,
I know, no, dude, I hear you. And people think something's gonna happen or whatever. It's like,
and I don't ever want to make people feel dumb, because like I didn't have a system for like the first couple of years of trading. I was just like, when the market pulls back at open, I go long. That's not a system. Like, you know what I mean? Like, what? When do you exit? What's your criteria? Why are you doing this? What? So most people don't even have a system, a concrete system, an exact reason as to why they are getting into a position, an exact reason as to why they're getting out of a position. Yep. If you don't have a system, you don't have anything. Like, I treat all of my trading, I have standard operating procedures for everything. Right? Like, there is a manual for how we do position sizing. There's a manual for what we do with the monthly time frame. There's a manual for why we're going to enter, why we're going to exit. There's a manual for every aspect of that, how to scale, right? Because we have to know. When I'm trading, it's not based off of what I feel. What I feel is normally different than what I'm doing. You know?
Can I piggyback off that real quick?
Yeah.
This is where, I know you said earlier you consider trading, gambling the same thing. Mm-hmm. And I don't know if you know who Tony Batista is, but he's one of the Tasty Trade guys, former SIBO market maker, older gentleman, been in the game for a long time. And his point of view is all gambling. Mm-hmm. And so to me, whether you call it investing, whether you call it trading, whether you call it gambling, I think the real gambling, if you will, is all these people who buy stock, but then they never have a reason, or they never know when they will get out. Yep. And this is, to me, the thing that I try to rebuke the Tesla community about so much, is everybody wants to buy and hold forever, which is fine. That's fine if your name is Ron Barron and you're this crazy billionaire who has all this money, and it's not going to hurt you or anything. But if you have a family, if you have a plan to retire, like, even if you want to hold it forever, well, what's your plan to extract capital out of that? Like, what's your plan? Like, at a certain point, are you selling? If so, when and why? If not, how do you extract capital out of it? And what if the thesis doesn't go your way? What if we're sitting here in 10 years from now and Tesla's still at $400? Then what? Like, you have to, even if it's unlikely, what's the plan? Like, what do you do at that point? And to me, it's more gambling to be a stockholder, long-term stockholder, and not know what your exit criteria is or your criteria to take some off the table. To me, that's gambling.
Yep.
With options, with what you're doing, we have rules. We know when we get out. We know when we get in, especially when it comes to options. Like, you have an end of life on those contracts, and you know statistically what your odds are at all times. When it comes to the stock, it's like, well, this is going to happen at some point one day. I don't know when, and we'll just hold on. It's 50-50 from here till then. And to me, that's the real gambling, is the lack of understanding what you did and why you did it. Your thesis on the company and what their vision is, that may be all correct. You may be spot on that, but you aren't spot on with your investment. I mean,
Yep.
what's your take on that?
I think investing is more gambling than trading, and I think that that's something that so many people like that. It's a controversial take, but
Yeah,
I think
I
that it's
agree.
more. I think it's more gambling because, number one, you're not predefining your risk. How many people today, and if you're listening to this, ask yourself this: how many people today plan on their entire Tesla position going to zero? How many people actually think, could Tesla go bankrupt? Could something go bad with Elon? Could something terrible could happen? Could they lose the AI race? Could they lose the robotaxi? Could Waymo actually? Nobody. Because here's the thing, if they actually thought that there'd be a piece, they probably wouldn't invest. And to
Yeah.
me, that's gambling because you're not predefining your risk, right? You have, like, how many companies have you seen in your lifetime that just long-term buy and hold didn't work, right? And so that's why I hate the idea of long-term buy, like Beyond Meat. Imagine if you bought that when it IPO'd in 2021, bro. There's so many of these companies, and of course, like, they're different companies, right? They're completely different companies fundamentally. You can give me that argument all day. That's completely fine. But the way that I look at it is the fact that, like, so when I'm running my back testing or I'm sharing back testing, people are like, oh, look, your system barely beats buy and hold. Okay. Buy and hold, in my opinion, like returns over 20 years or 10 years, it's all BS. Who would have not sold at all? Okay,
Yeah.
you would have made a 20,000% on NVIDIA in 20 years if you did not sell once. You can lie to yourself all you want, but you would have taken profits at some point. You would have done something. Because once again, if we're thinking about this from a gambling perspective, that's equivalent to sitting at the blackjack table for 20 years and amassing your chips and never cashing out. It's not going to happen, right? So,
And then the question becomes, well, then why haven't you done it?
yeah. And so I think that the reason so many people long-term invest, there's some main reasons, right? Number one, I think it's a psyop. Like, the piece of it is like a psyop of, like, invest in these companies because it's good for you. It's good for the American economy, right? It's good for these businesses. It's good for the American market so that they can take your money, they can go grow, they can build GDP, all that. That's great, right? The second thing is that there's also, like, this lie of, like, give it to the hedge fund managers because
Yep.
you don't know what to do. They know what to do. You're just a simple person who can't do this on your own. Like, no, that's not the case, right? Then there's the actual retail investors who want to pick their own stocks. And I don't necessarily think there's anything wrong with that, as long as you actually objectively say to yourself that this investment could go to zero. You have to say that to yourself. Or, what will happen in order for me to leave? There has to be an exit trigger of some point. There has to be, unless you actually plan to lose the entire position. Because if not, you have no risk parameters, right? When I take an options position, it's actually not risky because I planned from the very first time I got into that position that this is what I'm willing to lose. And if I lose it, so be it. And I mathematically set everything up based off of that loss from a risk standpoint. But I think that the reason so many people, it's a good idea to invest, for so many people long term, and they don't think about trading, is because, once again, it does bring some leverage to your life. You're going to, in most cases, get a way better return buying and holding a stock, a Mag 7 or even the S&P 500 than most real estate. It's going to be more liquid. It's going to be better than just holding cash and having inflation eat away at it forever. But yeah, I don't see long-term investing as safe. I really don't, because what we look at are those major companies in the past decade or 2 decades that have done very well. But how would you have known back then that that was the one that would have done well versus the other hundreds of companies that went to zero? Like, you look at Sears. How many people worked at Sears for 50 years, had their pension in there, at one point stock, and it just goes to zero. It all crumbles. Entropy takes over. Like, these big companies, all these AI companies, some of them might not be here in 20, 30 years.
Yeah.
Right. And some of them might overtake everything. Like we have no idea. I agree with you in that regard.
Let's talk about Tesla then. All right, let me. I don't think you've done a video on Tesla recently since we've had a pullback. So, and maybe by the time this goes out, you will have. But I'm curious. So, BX Trender was pretty constructive for a while. We broke 420. We went all the way down to, I don't know, 395, maybe something like that. The daily on the BX has gone red. Actually, I think it's light red now. Monthly still good. Weekly's not good. What's Peter's take? Or do you think we're going down to three? Not financial advice. Let me just say that.
Yeah, of course.
Should have said at the beginning. But
how I'm doing.
Like, yeah, like how are you looking at it right now? And then I have a more nuanced question with regards to the BX.
Yeah. So I am right now still from a macro standpoint bullish. Right. When I look at a chart, everything that I do is top down. Right. So I always start with a monthly time frame. I always start with the biggest time frame, and then I start to move my way down. I like to think of it like if I'm a scientist and we have something in a petri dish, I'm like zooming in each and every single level.
And
right?
and do you do that because it's more signal because it's slower moving? You can see a better trend, or what's the rationale?
So it's slower and it's stronger. Right. So the thing you have to realize is that all indicators are lagging. That's the number one thing, right? Like what we're doing with these indicators is not looking to get in before the move happens. Like a move has to happen, then confirm the indicator, then we take our position. It's why we're never going to sell at the perfect time. We're never going to buy at the perfect time because we're always going to be doing something half a step behind. But it's okay to do something half a step behind over the long term. Now, the reason I start with a monthly is because number one, the actual players who can move the market are not caring about what's happening day to day. Like they really aren't, they're focusing a lot more on the macro and they're focusing a lot more on these bigger timeframes because number one, these huge investment firms that from a tax incentive standpoint, it's a lot better to hold on to a stock longer term for 1 to 2 years as opposed to short-term capital gains. So most of these companies are trading under C corps and tax structure is completely different, but that's one aspect. The second thing is that these indicators are always going to be stronger. So if you were to just follow the BX trender alone as like its only reason for entering a position on a daily time frame, it's like a 35% to 40% win rate. On a monthly time frame, it's up to 67% to sometimes 70% because the bigger time frame is so much stronger. So the thought process and the framework that we want to go through is first and foremost, what is the macro time frame showing us first and foremost from a buying pressure standpoint? Because as we said before, if buyers are not entering into a stock, it doesn't matter how much of a good value a stock is. Yet, if you bring up Palantir, which has a crazy PE ratio for most people, look at what it's been doing for the past 12 to 24 months, right? Nothing but going up, nothing but showing expansion, nothing but exploding. So we always start with a monthly and we always get an understanding of what is currently happening. Right? So that's the first thing when it comes to buying pressure. Then we want to look at structure. Right? So structure is always going to be, a lot of people get structure and trend mixed up with, but what is the overall structure of the market? If you look at Tesla from like 2021 till 2024, like Q4 of 2024, when I started heavily getting into it, I'm sorry, like Q3, I think it was like June, July. You'll notice that every single time it bounces, it's making a lower low. Right. So what, from a psychological standpoint, what are all of those bounces? All of those bounces are traps pushing the stock up, then either institutions shorting those bounces or removing their longs from those bounces. So if something is constantly going down and bouncing and going down, what is telling you that it's finally the bottom? Right. It's not until that structure shifts that we normally actually see a bull market. So a lot of people ask me, like, why do I not short stocks? Because what I'm looking for is an uptrending bull market with macro buying pressure on a monthly time frame. And then the third piece of the puzzle is I want to make sure that when I'm starting a position, I'm getting it at some relative discounted price. So I'll start with the monthly. Yeah, it's a great example. Here you go. Yeah. So, if you're looking at 2020, let me make my screen bigger. Boom. Yeah, so if you go back and you look at like 2021, 2022 into 2023, and you used to draw a trend line from those resistances all the way down, right from that very high back in 2022, the very top
Yeah.
candle all the way down, you'll see that it did absolutely nothing but continue to make lower highs and lower highs. And there were
Mhm.
plenty of times where there was actually buying pressure coming into the stock, but every single time that there was a bounce, it continued to sell off. So the first thing we want to do is take a look at what is happening on that monthly time frame. Is the BX trender increasing? So increasing would be light red or into green. And as you can see right now, that's exactly what is happening. At this point, we have nothing but buying pressure coming into the stock. So what I would do from this point is then move into the weekly time frame, because we know, and I like to think of this like waves, like the macro buying pressure, there's a lot of money still coming into this. Doesn't mean that the stock can't pull back at some point,
Yeah.
right? So if we look now at the weekly time frame, you're going to see that it's currently red. Now, here's the cool thing about the BX trender. It's just an RSI. Did you know that?
Yeah, it's a long term, a short term RSI, a couple EMAs
Yeah.
also, but yeah.
So
long
you'll
short.
see like when that RSI is crossed above the SMA, it's green.
Mhm.
The BX trender is green. When it's under, it's red. Right. So the only reason that I like to use this over relative strength index is basically because I think the vertical like bars in the histogram is a lot easier for people to understand.
Mhm.
Now, what I like to do, and we don't have it here, is I like to have an overlay.
The
So I like,
volume.
yeah, it was no. So I like
Yeah.
to have an overlay of the BX to where you can see the monthly BX while you're looking at a weekly time frame. So this way you can
Okay.
see these pullbacks that end up happening within that monthly breakout. So if you look at what's happening right now with Tesla, very, very good chance that price will potentially bounce here. But in my expectation would be that it pulls back down to about $350. If you go into your indicators, look up market bias. So the market bias is a trend-based indicator, right? So this is going to show us what is the current trend of the stock. Now you have to go to the market bias. You see under sell button at the top left, you can see the actual market bias there. Hover over it, go down right there, hover and hit the second cog. It's the second one right there. And now change your settings, period, do 20. And then smoothing, make it 8. And oscillate, yeah, 8.
Why these?
Yeah, great question. So the main reason is the period is going to be this indicator is based off of SMAs and a Heikinashi. Now, see where it says show HA candles under display settings?
Yep.
Unclick that. So basically what this is going to do is show us a 20-day SMA, which is the
You
top
want
band.
this at 7?
Make that 8. So 28.8. There you go. And then hit OK. So what this is going to normally do is show us a 20 SMA, which is that top line, and then a 33 SMA, which is going to be that bottom line. So that's where the smoothing comes in. This is normally going to be where a stock pulls back to before it bounces. So you can see that back in the summer, each and every single time that the stock pulled back and it was compressing, what did it never break? This is a huge reason why I was long the entire time on Tesla throughout the summer, because the monthly BX trender was showing an increase. It was showing buying pressure, even though there was a compression that was happening on that weekly time frame. The compression was a bullish compression, right? We have that month of in July. So if you hover over July, that monthly candle of this year, to the right more.
Good call.
Very good. Keep going a little more.
I'm almost there.
There,
Wow.
right? So,
There we go.
So August into July, you have that increase, and that entire compression, that entire squeeze that was happening the entire time was happening within a bullish expansion on that bigger time frame. So if you think of it like a wave, you have all this buying pressure coming in, but price is sitting sideways. So as price is compressing on that weekly time frame, it is a pretty good sign, not all the time, that price is going to expand to the upside, that price is going to break out. Now, if you go back to the weekly, you can just type 1W if you want to hotkey it.
Oh, okay, I got you.
There you go. That's all good. So if you look, price pulls back into that weekly. Now, the two indicators that we're really using here is the BX trender and the market bias. So the BX trender is going to tell you buying pressure, and that market bias indicator is going to tell you what the trend is, and more importantly, when is something undervalued versus overvalued. So when price is pulling back into that bias, it's normally a good time to go long. When price is expanding away from that bias, it's normally time to be taking some sort of profits off the table. Now, the bias indicator specifically acts as rungs in a ladder. So if you're to zoom out a little bit more on this chart, right, you're going to see back here through July of 2024 and September of 2024, like to your right there, as soon as we started bouncing over there, each and every single time, this is where I made the bulk of my return on Tesla was each and every single time it pulled back into that bias zone is a time to buy. The more that it expands, the more profits that we want to take off of the table. So think of it as like,
And when you're saying you're expanding, you're talking about the width of this, right?
yes. Yeah. So as it's pulling into that level, that's basically like our buy zone. So as it's pulling into that level, that's the time to buy. The more that we expand, that's time to reduce position size. Now, for me, it's very rare that I do like one exit. What I'm looking to do is accumulate more as it's pulling into the band and then take price off as it's expanding away from the band. Because from a risk versus reward standpoint, it's getting worse and worse.
Yeah.
Now, going back into those timeframes that we talked about, what will normally happen, right, is when like the bias will act as rungs in a ladder. So if you look at March when like Tesla was just burning to your right more, for when it went from like 440 all the way down, you'll see that that bias did not hold, right? Right there to your left. Yeah. So you'll see that price pulled into that bias. I tried to buy it and it failed. That's what a failed trade looks like. To absolute perfection. That's what it looks like. So now, once that time frame support breaks, what is normally going to happen? It's going to move all the way down to the next time frame support. So if you go out to the monthly, you can type 1M if you want a hotkey, or just go up into there. There you go, and hit enter. So if you look at the monthly, where did price pull back to in March?
Wait, are you saying I can just type in 1M without clicking up there?
Yeah. You can do 1W for 1 week.
Oh, man.
Yeah, there you go. Yeah. Lifesaver.
All right. Yeah.
So, but if you look at this, right, you'll see that price pulls right back into that support and bounces. So I'll take a loss on that weekly time frame when that support breaks, but then I'll let it burn into that next support level. And that's another good time to go long. And even going back to what we were saying before about, structure and trend, look at 2022 to 2024. It did absolutely nothing but trade underneath of that bias. It was nothing but red the entire time, which in most cases means when it bounces, right, it's going to sell off again. Now, if you go take a look at the S&P 500 on a monthly, so type like SPY, you can just type it. It should come up.
Oh, I did. Wow.
Now you're all good, bro. All right. So if you look at the S&P 500, you'll see in most cases, this is the time to buy. There are sustained times in 2022 where it doesn't end up bouncing. But if you zoom out, you will see that basically besides the '08 financial crisis, which is right there, and the 2000 dot-com bubble, those are the times where we get full structural breakdowns. Where like once that breaks, you don't touch it again until we break above that level. Now, once again, that's where discipline comes in. Because how many people could have sat through the dot-com bubble and sat through the '08 financial crisis and not tried to time the bottom?
Yeah.
Right. A lot of the times it's inaction. It's not doing something that actually gives you an edge in most cases. So with Tesla right now, I expect worst case if you go back to the weekly. So hit 1W.
Oh my goodness. I love these short.
Yeah,
I don't use
good.
TradingView that much.
Yeah.
Honestly, I only use it for the BX Trender and RSI. And then but anyway, so
yeah.
That's a nice trick.
Yeah, it's nice. Yeah. So if you look at Tesla, it looks like worst case scenario for remaining objective here. I do think price is going to bounce. I do think in the next 6 months, we're going to be up about $600 to $700, but I'm not ruling off the idea that it could pull back to 360 or 350 one more time. And what you're seeing here with with these big breakouts and then these pullbacks and these breakouts, that's market structure itself. And so you have to think to yourself, like, this is how institutions move, right? They're buying discounts and then they're selling premium markets, and then they're waiting for price to pull back into the discount. They're buying the discount. Then when it breaks out, they're selling a premium market, and they're doing it over and over again. And when you think of the market as basically like a weighing machine, a lot of people say, well, how is it that easy to just buy on the pullbacks and break? Like, how do you know that? Well, think about it. If people are not buying those tops, it will not continue to go up. And this is where, like, in the trading world, we say like retail is exit liquidity, right? Everyone who was buying Tesla, and sorry if there are people here who are doing that, who were buying Tesla back in January of 2025. Were you really buying it at a discount?
Yeah.
When you could have bought it at 200 in September of 2024? Not really, right? And so I think this is the hardest thing with my analysis, because sometimes people are like, well, what's going to happen with the stock? Well, there's a big difference between I think the stock is going to continue to rally versus is this the time to be buying, Like if you go to Palantir, so just type PLTR and then hit enter and then hit 1M.
Oh yeah. This is ridiculous. This is ridiculous.
Look at the monthly BX trender, right? It's still telling us that this is a bull market, but is it time to buy Palantir?
Yeah.
No, like you are not getting that at a discount. And so I think that once again, one of the hardest things is to be able to objectively look at something and say, this is still a bull market, but is it time to go long? No, it's not.
So with your Tesla position right now, last I recall, you had some longer dated leaps on.
Yeah, April 560s.
Okay, April 560s.
Yeah.
So whenever you saw us on the, am I on? No, let's do.
You're on the monthly.
Use my new trick.
Yeah.
When you saw the weekly go to red, the monthly, like we're talking about, the monthly is still green, but when you go to the weekly, it's red. Obviously, the daily is also very red. Did you decide to do anything from that, or is that a long enough time frame on your leap, or it's not even a leap, but on your long call option that you're like, this is enough time where I'm gonna listen more to the monthly? Because the reason I ask is I know you have some shorter term trades, like it's like 3 months out that you're like, I listen more to the weekly, daily rather than monthly. So maybe you could walk us through how does Peter think about these and time of when I place a trade? Because again, last thing, you keep me honest with Tesla. I believe you tend to trade options rather than shares.
Yeah.
Okay. So
in most cases,
all that information, talk to us.
Yeah.
All that.
So the way that I look at trading options is different than trading shares, right? Because you have to manage your risk a lot more when you're trading options. Like AMD is a great example. One of my biggest profits this year with options. I think close to like $400,000 from low to high.
Wow. Yeah.
I did not hold the entire position the entire way. So if you're buying, so zoom out to the monthly real quick on Tesla. So just hit 1M. When you're taking a position, so let's say you're buying that pullback in March and April, when it was pulling back into that monthly bias. If you were to go and buy let's say 1 year out call options, and you were to go with a $250 strike price, you're not going to just continue to hold it the entire time. Because let's say you went in with $100,000. Now the stock is up to $406,000 and you're up 700%. From a risk management standpoint, now your fund is completely out of whack. You have a position, if most of your positions are worth 100K and now you got one that's worth 700,000, that position is completely out of whack. So the way that I like to explain it is when we are trading options, you have to do more trimming of the garden. You got to be cutting little clippings off. And
can I just interrupt you real quick? This goes back to your SOP, standard operating procedures, that, we talk about systems, entry system, exit system. But what you just said there, I don't want to just glaze over it. I at least want to bring attention to it. Part of a system is knowing how much you're willing to allocate to a position, right? And so no more, there's a maximum, right? And anyway, so I just want to at least call that out. It's a nice little nuance there that people should be aware of.
Yeah, and for me with my fund, I constantly keep things pretty neutral. So if certain stocks come out of the fund that week or out of my watch list, if I don't add an equal amount back in, then I'm going to go through and try to rebalance all of those positions. So in most cases, what I will do for something like Tesla, for something like AMD, is when I start that initial position, I will start it with the sheer amount of capital that I am willing to lose to test my thesis. Now, when it comes to options and why I do that on Tesla or AMD or some of these other positions, it's very simply because of the outsized risk versus reward. If that would have broken $220 back in March, I would have lost probably all $100,000 of that capital, and I planned on it. I'm okay with it. But if it bounces the way that I'm expecting, I could make 4, 5, 6, 7x. And that's what I'm looking for. Now, the way that I normally set up a position, or I like to think of things, is that we have this macro bull cycle. So Tesla's bull cycle started in the summer, right after bouncing. I could have one massive trade that lasts and spans the entirety of that cycle, or you can have multiple trades within that cycle, right? So the trade that I'm currently I have right now is not the initial trade that I put on, right? The initial trade that I put on. So I have already taken all of my principal out of this position, and I am just holding a position that's worth the profits that I currently have. And from a risk management standpoint, like I said, I made close to 1.9 million on Tesla in the past 3 years. This position's only worth 100K. So like, even if it goes to zero, I'm not giving back the house, right?
Yeah.
That's the most important thing. And I think it's the one thing going forward that I really want to spend a lot of time on, is like explaining risk management and exactly like the percentages that I look for entering a trade and how much of the fund and all of that. So
it's important because it like sizing appropriately allows you to actually be mechanical, allows you to, you have feelings, but you don't let those feelings dominate you because you're sized appropriately. It's like, okay, well.
And that goes back to being disciplined. It's a lot more easier to be disciplined when you're using proper position sizing. It all starts from that core. If I were to take my entire net worth and put it into one trade, do you really think I'm going to be disciplined about it? Like, no, every micro movement, I'm going to be checking, freaking out, all of that. So in the case of Tesla, like, I think my initial position was December 2026 for like $360 calls, right? Okay. So as a stock, I normally buy 3-4 strikes out of the money, so a little higher up in time. What basically gives an option its value is intrinsic value and time value. So intrinsic value means, is the strike price you have worth less than the current price of the stock? So if you're trading out of the money options, you have zero intrinsic value, because if you were to buy the shares today and exercise your right, you're paying more than what it's worth. So the only thing that gives that value is time, is the what if, what could happen if Tesla breaks out in the next year.
And for the people who follow me, what I always tell them is, like, to your point, you have extrinsic and intrinsic. Intrinsic is everything in the money. Extrinsic is everything else. So combine those, there's your option price.
And the only thing that gives that extrinsic value is the time, is the what if. Right. And that's why when you're buying an option that's further out in time, it costs more money, because you have more what if and you're paying a premium for it.
Exactly.
Versus if you buy something.
That's a great way of saying more what if. I love that. I'm going to steal that.
Yeah, dude, do it. Yeah. So that's like basically what you're paying for. Now, how I trade, it's a little bit different because I do trade some more size. So without getting like too into the nitty gritty, basically what I want to look for is making sure that on the chain, the actual options chain that I'm looking at, that there's enough volume in a day where I'm not going to get killed with slippage. So every single market, whether it's options or stock, has, and you can see it right now at the top left of your screen, the buy sell, right? So that is your bid and your ask. And so you can see right now, the spread between that bid and the ask is 13 cents. So that means if you were to hit the market button, you would instantly fill at the worst price and you'd slip 16 cents per share. Now in the options market, it's way different. You could slip 5, 6, 7%, right? There's a lot of times people have probably seen like, oh, I'm up $1,000 on a position, and they hit market sell and they only made 900. Like, what happened? Like, did the stock dump that much? Like, no, you just filled at the worst price possible.
Like MicroStrategy, APP, like they have huge spreads.
Yeah, they have huge spreads because there's not a lot of volume in the options market. So what I like to do is I want to always trade something that's just a little bit out of the money with a lot of time, because I have that time.
Define that. What's a lot of time to you?
So
3 months,
that's a
6 months,
great
a
question.
year, 2 years?
So you take the amount of time that you expect a stock to move and double it. That's what I look for. So statistically, if we're looking at Tesla, like let's say I think it's going to take 4 months for this to play out, I'm going to go with 8 months till expiration. If I'm playing a monthly chart only, and I know that the average bull cycle lasts 10 months, I'm going to go with 20 months till expiration. Because we always want to bake in something terrible happening, right? Or something not working out the way that we want. Yeah. Or multiple months that a stock could just sit sideways, but still meet criteria. So I will pick like when Tesla's pulling back into that market bias back in April, May, June, right? If we go long, we're going to go with, let's say price is trading at $240. I'm probably going to go with like $300, and I'm probably going to go, say, I think it's going to take 6 months to move, about a year out in time. Now, if the stock just continues to burn, I just hold the position until my exit criteria happens. And this is why I plan on losing the full position when I take the trade, because I don't know how long that exit criteria could take. We could get lucky and it could dump. That's actually best case scenario, right? Because it just dumps and then we get out. Worst case scenario is we spend multiple months slowly moving down, and now we're losing money to theta decay. and we're losing money to the actual position not going the way that we want. And so I always plan that the worst case scenario is going to be I lose the entire position.
What do you do if neither happen? What if we just continue to go sideways and we get closer and closer to expiration? Do you decide to just let it decay, or do you roll out?
So
What's your strategy?
good question. So basically that's why I go with double the amount of time to like bake that in. So in most cases, I just won't do anything. I'll just continue to hold on to the position. If it's really taking long and my criteria is still met, then we could roll it out. So let's say nothing happens at all. Right now it's like November 17th, right? So let's say that we end up getting November calls for 2026 and a whole month goes by, stock didn't do anything. And I'm starting to think to myself, maybe I'm a little worried about this. You could close it out and then open one an extra month. But in most cases, because I'm baking in that double the amount of time, I don't normally have to ever deal with that. That doesn't normally have to be an issue. But yeah, if you were trying to be like really quick, because the thing that makes options trading hard, right, is that we're not just trying to pick the direction, which is hard enough. You're trying to add the timing of the direction, which makes it even harder, which is why so many people fail. And it's okay to fail. It's okay to lose money. You just have to predefine what that loss is going to be from the beginning. So what I'll normally do is if I buy a stock, I'll let it hit the stop loss, wait till criteria is no longer met, which in this case would be monthly BX, just breaking under that monthly market bias. Or if price bounces, then I will let it continue to move up until we get in the money. So let's say price, we got $300 calls, it's trading at 260. Once we hit $300, then in most cases, what I will do is close out that position, taking that profit, and then I will take all of that capital and put it into, in most cases, the same exact date, but now 2 more strikes out of the money. And I will continue to do that. And every time we hit the target, I will take some out and I'll continue to move up. Now, the thing is this, as we continue to move up, each time I roll or each time I close out the position, I will only take 90% or 80% of the worth of that position and roll it into a new one. So the whole time you're taking some chips, you're skimming some, because the whole thing is you don't want to skim too much off. Because like we said, going all the way back to the very beginning of this, you need to let your winners run. Yeah. You have to, and this is why having a system is so important, because the biggest thing that's always at the forefront of my mind is I make my money not from my accuracy. I make my money from my risk versus reward, my outsized upside from my downside. So if I start taking profits too early, statistically, I will screw myself, right? It'll increase my win rate a little bit, but not enough to make up for all of the potential downside that I could have. So what I'll do is I'll just continue to roll that position, take some profits off the top until we eventually get an exit trigger, which would be the monthly BX flipping red. And I'll just continue to do that. And at some point, we're going to end up giving a good percentage of profits back because every market is going to top, but it's a part of the game, right? There's no real way around that. You'll see it like on AMD chart, you'll see it on NVIDIA chart, you'll see it on all these different charts. But in most cases, like that's what you're looking to do, is to manage your risk by doing that. And so with Tesla right now, I currently have April $560 calls. Tesla's trading at $406, which is crazy. It was at 420 earlier. And I was expecting, so basically,
I was excited. I'm like, man, it's gonna be a fun conversation today. Yeah. We're at 420.
Yeah. And so that's the thing. Like a lot of people, like I just posted on Twitter that like, I'm still bullish, still same, everything we're talking about right now, like macro bull, I think it's going to pull back to $350. And everyone's commenting like, how are you bullish if we think we're going to pull back to $350? It's like, well, I'm also objective, like you can be bullish, you can be objective. And if you look at that weekly time frame, it looks like we are loading back up for another breakout. It looks like we are going to compress and pull back, much like what we did back in the summer, then hopefully bounce and then break out and move from there. But as long as you're still seeing monthly buying pressure on that bigger time frame, it's a really good sign that we're going to bounce. A good example of this too is actually if you want to look at Bitcoin, so you do BTC USD, there you go, and click there. So if you zoom out here, you're going to see, like, once again, market structure, once again, trend. Most cases, when it pulls back into this discount range, it's going to bounce. Now, if you hit 1M to go to the monthly, what will you notice about that entire breakout? The BX trender was green the whole time. right?
Yeah.
So this is where I try to explain to people that like you can have a a thesis or fundamental thought process behind what you're trading, but what is the buying pressure on this bigger time frame? Because if you look at Bitcoin, each and every single time it pulled back from the year 2023 until last month, it showed buying pressure. It was showing green. It was holding green the entire time, which means that you can buy those dips. If you look at Bitcoin right now, not looking hot, right?
Yeah.
The month of October closed red. So if you look at the very beginning of this month until right now, that pullback was pretty given.
Do you ever look at the numbers on the side? Like right now, it's minus 26. Do you
No,
ever look at those?
nah. In most cases, no. Because the thing is, I've back tested and strategized the numbers. I've strategized higher lows. I've strategized exiting when it's dark green versus bright green. But the biggest thing that I've noticed is if you're working on a monthly time frame, you very simply wait for increase. So higher low. Basically, don't trade dark red. That's it. Just don't trade the dark red. That is normally the best thing that you can do. There are what's called divergences. You know what divergences are?
Yeah.
Yeah. So
But I
like
don't know if everyone does.
yeah. So if you look at like right now on Bitcoin, those three breakouts, what was happening on the BX trender the whole time? It was still green, but it was making a lower high each and every
Yeah.
single time, showing weakness. So still a bull market, but it's weak.
Yeah. So in other words, boom and boom.
Yes. Yeah, exactly. It's diverging. And that's normally a sign that we're going to hit a top. But once again, I'm not one of those people that tries to be preemptive. Like I wouldn't look at that and not buy the dip. I would just continue to buy the dip until it keeps dipping, then take my loss and wait again for a bounce. And if you look at Bitcoin now, it looks really good that we're probably going to pull back to that bias once again and bounce between 70,000 to 80,000.
Do you find that it normally comes all the way to the bottom of it, or do you
It
normally
depends.
find it? Yeah.
It really depends. Like in most cases, once it gets in, so this is where we can get into like the nitty gritty. In most cases, when it comes into that bias, I will be looking at the weekly time frame. If you actually go into the market bias settings, you can go into hit the setting, yeah, and then it should say see time frame. Click chart where it says time frame chart, and then turn it to monthly. So this would be a good example to do this actually on Tesla. Yeah, now hit OK. All right, so now go back to Tesla. Just hit TSLA, and I'll go to a weekly time frame. So hit 1W. All right, so this is where you can get a little more into timing things. So now what this is going to show you is a weekly time frame and a weekly BX trender, but a monthly market bias, right? So yeah, so now you're able to see what is a discount in the monthly time frame, but you're able to start trying to ping the bottom on a weekly. So what I'll normally do is when price is pulling back into that monthly, I look to the weekly BX for my first sign of a bottom. And so you'll see here back in, what was that, April or May, right? You would have had an increase on that BX trender, the very first one to your left right there. So right to your right a little more, where it increases from dark red to light red. First time.
Right.
Yeah, right there. Yeah.
Right here.
So that would have been your first sign to go long. And then you would have exited on the very next candle. It would have taken about a 5% loss. It's not the end of the world. Then you would have entered again on the very next candle that pings high low. And then you would have played that breakout, compression, and then breakout again. So this mixing of time frames of knowing like what is the big time frame, what is the monthly doing, what is considered a discount or a fair value, and then if you really want to try to time things on a smaller time frame, like going in on that smaller time frame, then you can look to try to get in early. Now, the thing is, there's always give and take, right? So if you try to do this on the weekly time frame, you're going to get a better price, but your win rate is going to drop, right? Because you're going to get more false signals. If you wait for the higher time frame, your win rate is going to be higher, but you're going to be getting in a little late. And the thing is, there's no way around that, right? Like when you're building,
pick your poison.
Yeah, when you're building a strategy, you know, you're basically there's two ways to build it: something that has very high win rate with very low risk versus reward, or something that has very low win rate with very high risk versus reward.
Mm-hmm.
If you know somebody who has a 90% win rate with a 10-to-1 RVR, let me know. right? Like that's like the holy grail. That's perfect. That's not going to work.
Yeah.
Which is something to think about.
Yeah, it's interesting. So the way I trade, I pretty much just trade options. I don't really do a lot of shares.
Yeah.
But I've been able to take a lot what I've learned from you. And we talked this last time. I'm kind of the inverse. I tend to have higher win rates because I'm pretty much a option seller trader.
Yeah.
But when I take my shots and I buy options, I'm literally using pretty much everything that you've taught everybody. It's and I even use what you've taught to sell options because it shows me like, hey, is this the right time to be putting on a put spread, or am I about to get my face ripped off because
Yeah.
I don't understand where the market structure is going, where things are trending, what's the BX doing right now? So it's become very, very helpful. But to your point, technically when you sell options, sure, the win rate will be a lot higher, but you're also risking a lot more.
Yeah.
When you buy options, you're defining your risk, ergo the odds are lower, right? So it's like anything. When you define your risk, odds are going to be lower. When you have unlimited risk, odds tend to be in your favor, right?
Yep.
You win a lottery, $1 risk, unlimited upside, right? Vice versa. But it's amazing to see your clarity and speaking and instructing has been able to, I would say, transcend different trading styles, whether it's what you do, whether it's in the options market. To me, it seems like it stands a test of time. But I'm curious, what I think it's to give credit to the quant. I think Puppy Therapy is the one that came up with BX Trender, and but like, how did you come across these indicators, and why did these speak to you rather than just using MACD and RSI or EMAs, etc.?
Great question. So basically, a lot of finding these indicators was just hammering through them with friends, right? So like me and my buddy Ken, every single day we would go through, look at a bunch of different indicators. He would mess with the set, and that's the thing too, right? Like I would take the indicator. This is also before ChatGPT, right? So like I can't code at all. There's no vibe coding. There's nothing. So what we were really doing was taking pre-built indicators and using them as vessels, right? Like I can't, especially from a back testing standpoint, right? Like if we can run back tests on specific indicators, but we can't build the indicators, then let's try to take the shell of an indicator and put what we know into this indicator to use it as a tool. And so that's where we ended up going in with like the BX trender. Was like, I found the BX trender and I was like, okay, this is basically like an RSI, but from a standard operating procedure, it's very hard to teach somebody RSI. Right? It's very hard to say like on the increase. Well, what is an increase, right? On the BX, I can say an increase is a shift from dark red to light red or dark red to green, right?
Yeah.
What is a decrease? What is it? The other thing too is a decrease below a constant value of 0. So that is the BX turning red. That's when we want to get out. So I felt that using that tool specifically was much easier. Now, the funny thing is when you're using the BX trender, it does not represent the RSI. Like the actual regular settings, I think is like 120, 100. It's like something different. So I just literally sat there and configured all of the numbers until it matched an RSI, like just being wrong for like hours upon hours until I was like, this is a direct representation of the RSI. This is what I want. This is what I'm looking for. This is what we're going to keep. And so that's how I got into that. And the thing with like market bias is talked a little bit earlier about structure and trend, right? So structure is like the most important thing in the market, and structure is entirely done through Fibonacci's and drawing Fibonacci's. I feel that like the free Fibonacci course that I have is like probably one of the easiest ones to understand, but teaching people Fibonacci's is so hard because it's not as easy as say, like if I say to you, draw from swing low to swing high, what swing low? Why is this constitute as a swing low versus this prior one as a swing low? Like, and it's very hard to teach somebody that. But if I can instead say, you go long when it's pulling into that band represents a discount, then you don't need to draw a Fibonacci. And so what I did was basically took the strategy that I was using, Fibonacci's. Okay, well, I can't create an indicator that just draws Fibonacci's consistently, but I can make this market bias indicator match my Fibonacci's. That's how we get the number that we're looking at. I can't easily tell people how to use this RSI, so I'm just going to build a BX trend around the RSI and then tell them to use the BX trender. And so that's basically how I came up with those indicators specifically, not saying anything bad about the people who made them, because like, dude, very happy that they did, but like, I'm not using them for the way that they intended them to be used.
Yeah.
I'm taking them as a shell, putting it around what I'm doing, around my strategy, around my framework, and then just using that indicator as something that I can teach very simply as a strategy, and put a standard operating procedure to it.
That's so cool, man. That's as again, someone who's been following you for a long time, to know the behind the scenes, like that's pretty cool. I didn't realize that's what you were doing.
There's no like crazy thing. It's just I had no other way to do it right now.
No, but that's awesome. You solved the problem, which was, you're right. Like, people, when they're drawing fibs, it's like, why is this the low and not this one, or why is this a swing high, but what about this one? And then whether it's extensions or retracements, like, it can, in what time frame, like how far back do I go, like what matters, what doesn't matter. And the fact that you saw that problem and you solved it in a more, again, like, you're a teacher, right?
Yeah.
You saw that this wasn't resonating with students, and so you found a way to make it resonate with them. Because at the end of the day, you're not trying to actually teach them the tool. You're trying to teach them how to trade, which you need to know how to use the tool for that. And so let's help people get out of their own way, because we have a bigger thing to learn, and we don't want to spend all the time just on how to draw a fib.
And then it also becomes subjective when you're drawing Fibonacci's, right? Because it's like, once a support breaks, then you can just draw another one, and it's very easy to be like, hey, look, I would have drawn it here. Like, okay, you would have done that because it already broke down, bro. Like, but what was happening back then? And that's why with the market bias, like I said, when the weekly breaks, then we're going to move to the monthly. When the monthly breaks, then it's going to move to the quarterly. Well, why? Because that's what the Fibonacci is going to do. When a Fibonacci support breaks, then you draw from that next level, and then you draw from the level below it. So for me, it was always like, what is the simplest way to teach this, and now what I'm trying to do is build my own open source versions of these indicators, but with like deviation bands to take profit. Cause like, you saw those breakouts, right? What's considered overbought? Like, that's the next question. Like, okay, when Tesla's up like 100 and something %, like, how do I know that that's overbought? Like, yes, it's far from the market bias. It's far from being at discount, but how far do I allow it to go? And so that's where, like, I'm trying to create deviation bands on what's considered too far and when do we take profits. And this is the part, once again, where like doing this publicly and having a community and doing these courses, like, it really pushes me, because in a good way, where I can't have things be subjective. Like, I can't just say like, when it's overpriced, what is overpriced? Like, operationalize that, right? Like, what is this? And that's the thing where like most trading is so subjective. And the reason that so many students like fail is because they're not actually given a system. They either do what they feel is right, or they follow someone else who's doing what they feel is right. My goal, which I hope it doesn't happen, is I could get hit by a truck tomorrow and all my students just still know what to do, right? Like, they don't need me to be like, I feel it's overpriced, I feel this is happening. Like, no, it's a very simple system. And the whole thing too is like, it's not always going to be right, and it's not supposed to. What you're trying to build with the system is not perfection. You're supposed to build consistency, redundancy, and the ability to adhere to it. And when you have too many pieces to a system, it is very, very hard to adhere to.
You tend to be very technical based with your trading. But I will say you do, or at least in your commentary, you do. I don't know what's the right way for this. I'm not saying that your trading is based on things happening in the market, or what I would call market awareness, but you're aware when Tesla's delivery numbers are coming up. You're aware when there's about to be a Fed meeting. How do you think about that with your trades, and why do you look at that, or when, or how does that impact your trades? Let's start there.
Yeah, it's a lot of fun, but it doesn't impact my trades. I do it for fun.
Okay.
Like, dude, I watch CNBC just because I enjoy it. Like, I listen to earnings reports. Like, I listen to podcasts. Like, I just enjoy it, but it doesn't really affect my decision making. I love the fundamental aspect of the market and these companies, but I don't talk about it because I personally wouldn't make decisions based off like financially. And so I'm only going to share with people like what I'm making decisions off of financially.
Okay.
Um, but I do enjoy it, right? And the main thing that changed my career was realizing that all of my fundamental analysis was wrong. Like I was shorting COVID. Like, I was shorting. I'm like, dude, there's no way that their economy is going to come back. There's no way that this, like, the last thing I would have expected was the market to fully recover, right?
Yeah.
Back in April, when the whole tariff war started, getting increased again, so many people were talking about how it was the end of the world, right? Fundamentally, I didn't think things were good. Things didn't look great, but I was buying the dip. Why? Because the system said to buy the dip, right? So
Yeah.
I like to think of them as two separate things. Like my fundamental is like my fun time. It's like the ability for me to like stay up to date with what's happening in the market. But in most cases, when I try to mix fundamentals with technicals, it really hurts things. Because, like you said, poor delivery numbers that come out, the stock will rip. Great earnings reports that come out, the stock's going to dump. Like it doesn't, most of the time, it doesn't even have to come out with that. It's like, is Elon optimistic?
Yeah.
Like, I have no idea. Like, I don't know. He could wake up and stub his toe and be like, oh, this, I don't know. Like, I have no idea what's going to happen. There's too much variables there. But I do enjoy the fundamental side of things. And I just don't try to have it be a part of my analysis because then I can fall in love. Right. And I don't want
Fair.
to fall in love
Yeah.
with anything.
Well, hopefully not, there is someone out there.
Yeah. So, yeah. But the market. Yeah.
Um, I don't know if you consider this fundamental analysis, but what's your thoughts on increased liquidity? The Fed no longer in a tightening cycle. Do you factor that into anything? I mean, you would think in general that's going to mean more money supply,
Very
more
bullish.
bullishness. Yeah.
Yeah. From a fundamental standpoint, like I would think, and that's another thing, right? Where from a technical standpoint, technicals are looking very, very bullish in the market, and quantitative easing is very traditionally very, very bullish, especially for tech companies and small cap companies, because now there's more money that they can go borrow for cheaper to go ahead and either put into R&D or expansion. And then when you have this mix of like the AI, this is why once again I see so many people who are bearish on AI and the bubble, and like I get it, bro, it makes sense. People are worried. I could totally be wrong. But it's like, well, now you have this AI bubble, not bubble, but like this AI, like this AI cycle, we'll call it. And now money's cheaper. Like, like in a lot of cases, like that's pretty good. Right now, the American consumer is not doing too hot, like we said earlier. But in my opinion, like fundamentally, I think that's very bullish for the market overall, which is why I do think that from a technical and a fundamental level, the market's probably going to continue to run for another 6 to 12 months. And all these pullbacks are going to get bought up.
What do you think? This maybe touch on that real quick.
Mm-hmm.
The general American consumer, I keep hearing that they're not doing good, or that we have a bifurcated economy where we have like the top, call it 15%, are doing well, own assets. Things get more expensive and it sucks. Things get a little tighter, but like, their lifestyle doesn't really change. And then you've got everybody else who's struggling paycheck to paycheck. The new norm is to have 2 jobs and a side hustle. Both people in the household working. There is, I've talked a lot about this, but back in the day, a woman going to work was like, wow, we get this extra income that we get to use, and we get to splurge on these nicer things. And then we got into a phase where like, okay, well, now you both have to work.
Yes.
And then it became both people have to work, and hey, I got this little side hustle. Great. We can maybe pay off some debt, maybe take that trip, whatever. But now it's become, you both have to work and you have to have that side hustle. And so it's kind of crazy, but like, does this continue? Does it break? I mean, how does Peter DiCarlo see it?
Yeah, I think that, and I don't get like political in this too, but it's like,
no, and just real quick, just one last thought.
Yeah.
Like, I still go out. Restaurants are packed. Bars are packed. Stores are packed. I don't see anything slowing down.
So, I mean, I think there's a couple of things, right? I think that when you look at the next 10, 20, 30, 40 years, I think the wealth gap is just only going to get worse. If I was in politics right now, no matter what side it is, like if I was the left, I wouldn't be pushing whatever they're pushing, I'd be like, dude, the wealth gap is terrible. Like if we continue down this road and we can continue to do this, like your family won't be able to eat. Like I do believe the wealth gap in this country I don't know how to solve it, but it's just going to get worse and worse and worse. And especially with the introduction of AI and a lot of these, you have white collar jobs are going to be gone, right? But there's a lot of blue collar. Like think of how many truckers are going to lose their job as soon as Tesla solves FSD, right? How many DoorDashers, how many like all these people that, like you said, are relying on this to live, right? Like it all goes away. So I think that when you look at the American consumer right now, like we don't notice it because you have, it's sad, but you can really bend people pretty hard. Like they'll just go, like good thing about DoorDash, right? As much as so many people hate it, talk shit on it. Like if you need to get food tonight and pay for your bills tonight, you could go work a shift and get $60 and cash out today, right? So it's like with all of these newer ways of people making money, like Amazon Flex, DoorDash, all these things, like it allows the American consumer, in my opinion, to be stretched even further because they don't have to go apply for a job and hope that there's enough work. And like there is enough. And so it's like you're going to see spending continue. I don't think there's any way around that, right? Mm-hmm. Like that's one of the hard things about, like even when I had no money, I was still spending money. Like I would just go work more and live paycheck to paycheck. And that's kind of what the average American consumer does. But I think that when you look also, like you said, the top 20%, 30%, they're making more than ever. They have more leverage than ever. They have more upside than ever. And so like that is what's driving the economy, right? Like one of the first things that my mentor showed me in business, it was like so important, was he drew a gigantic triangle, right? And he put like a little line at the top of the triangle. So like it was like this much of the triangle versus the 90%. And he said, the people who control the 90% of the money that you should go after in business are in the top of this triangle. But the 90% of eyeballs are in the bottom percent of this triangle. And he said that when you go after the bottom percent of the triangle, you go after all the eyeballs, but they don't have money. So that's why businesses always say sell to rich people, right? Because number one, rich people pay more. It's also known that in most cases, they're going to complain less, right? Because they have more money, etc. But it's kind of the same way when it comes to spending. Like you have the top 10, 20, 30% who are spending a lot. And you have the smaller percent who are still spending a lot relative to what they make. But because inflation is, they're also poor financial decisions. Like everyone's their own person, right? Like people make just terrible financial decisions. Like
that was the other thing I was going to ask you. Like how much of this is accountability and poor financial decision, poor financial education? It's.
I am the first person to say like nobody deserves anything, right? Like I like. You don't deserve a car because you live in this country. If I was making $1,500 a month, I'd bike my ass to work every single day. I'd have a flip phone. If I wasn't making money on the internet, like there's no reason for me to be on social media, bro.
Like
and
you know what I mean? To live in Manhattan 100%, or Philadelphia or Chicago.
I agree. Yeah. It's not. When I say the wealth gap, I'm not saying like the oligarchy is like forcing people to like. No, people are just shit with money. That's like a big thing too. Like people have to look in the mirror and say like you don't deserve to go out to eat. Right now, people get upset by that. Like, oh, I do. Like, says who? You don't. Like when I
you haven't earned it.
Yeah, exactly. When I was driving DoorDash, like I didn't, and that was my only income, and I was flipping things online. Like I didn't deserve to go out all the time. I didn't deserve to do half of the stuff that like I want to do with my money because I had to sacrifice. I had to take that money. I had to put it towards my future. I had to live like eating peanut butter and banana sandwiches like all the time. And I think the problem is, and once again, I think a lot of it comes down to societal, where people feel like they have to keep up with other people. But I think it also comes down to like, when you don't have hope, it's very easy to just do what's going to make you happy today. Yeah. And so it's very easy to be like, I'm just going to go get the beer. Or I'm just going to go get, the cheeseburger, or I'm just going to go do this. Like, yeah, it's whatever. And the problem is it just becomes this, loop that plays over and over. And so I think there's a lot of accountability that people in this country just don't have.
How does that get fixed? Because I strongly feel like I see this a lot, and I think there's a big problem with the wealth gap. Yeah. I do. However, I don't think the problem, to be frank, I don't think the problem, I'm going to say a very generic statement here, but I don't think the problem are the people that have money. Mm-hmm. I really don't.
I agree. No, they're supplying jobs.
They're supplying jobs, they're creating opportunity. But to me, the problem is each individual person. Look, I always take this back. This is what I love about trading. You know who fucked up, Pete? You fucked up. You
Yeah.
lost that trade. You made that decision, and you have to reap the decisions. You know who made that money? You did. You made a
Yeah.
decision. You got into that trade. It's accountability 101. There's no one else other than you in the mirror. But I feel like when it comes to this wealth gap issue, we want to blame everyone. And then we act as if the problem is that, well, there's these people who got a tough start in life, or they were far behind, or they had this type of systematic thing that happened to them. It's like always this excuse. And it's
Mhm.
like, look, we all have our own things, right? Obviously, you have your story, which if you guys are still with us, go watch our first episode.
Mhm.
Pete goes into everything about his story, but Pete was not born with a silver spoon in his mouth. You
Mhm.
know, I moved here. My parents are immigrants. You know, like there's all kinds of stories. But at the end of the day, it's your decisions you make every single day. And so I guess my question is, how can we fix people's decisions? Like you can't.
Yeah.
I don't know how to have accountability, because it just goes back to the book Rich Dad Poor Dad, where
Mhm.
the rich learn how to stay rich. And rich is it's kind of a euphemism, but it's people with financial responsibility tend to be financially okay, and people with bad financial decisions tend to be bad at it, and the
Mhm.
cycle keeps repeating. I
Yeah.
don't know how you break that.
I think from like an educational standpoint, it's just really rough because people don't learn until they have to learn. Like a couple of years ago, before I started doing the YouTube thing, I would hold like local investing and trading and find like how to build your credit score in the really dilapidated parts of Philadelphia. And nobody showed up. Nobody cared. Like literally nobody cared, even though it was free. And it's I understand like when you don't have two pennies to rub together, why would you care about your credit? Why would you care about investing? Why would you care about all that? So the educational thing I think is really rough because you don't really learn until you have to learn. And sometimes when you're so down, it doesn't even matter. Um, as far as like the wealth gap, I don't want to get like nihilistic here, but I am a huge like I love capitalism more than anything, right? And I'm not talking about necessarily what capitalism is today, but I mean like pure free market capital.
Yeah.
And the beautiful thing about it is it only breeds the absolute best, right? Because if not, somebody will come in and knock you off. And I think that when you look at the whole Doge government efficiency thing, that's why a lot of people are mad, but it's like, well, the government has no competition. So when the
Mhm.
government has no competition, why would you be the best? Why would you spend the money in the best way that you possibly can? Why would you constantly push yourself? When you have no competition, there's no one there to take you out. Right. And if you look at like how the government spends, it is extremely inefficient. Right. And so
Yeah.
it's like, I think a huge way to help the wealth gap, first of all, is like spend the money better. Right. Like this year, I'm going to pay 45% in taxes. What are you doing with that? Like, where is it? Like, how? So I think that's a completely separate thing. But unfortunately, I'm very optimistic. I try to be optimistic. I think, and it's my biggest fear, but whatever, is socialism. And I think that is realistically probably what's going to happen in the next 20 years. As much as I don't want it to, I think that the wealth gap will only get worse. I think that AI will unfortunately make it even more worse. I think that universal basic income is going to eventually have to be something.
Well, it's interesting you say that, because I was actually thinking about this the other day. You know, under Trump's first administration, they gave out checks. Biden gave out checks, and now here we are with
Checks
Trump
now. Yeah.
talking about
Yeah,
giving out the
because that's
dividend.
how you win people over, right? And it's like, and here's the thing too, right? Like why does nobody talk about the wealth gap? It's even with the left, right? Like so like if you even look at the left, I always say to my friends, like I try to stay out of politics as much as I possibly can publicly because it just doesn't help, right? But it's like if I was the left, what I would have been pushing more than anything is the gap between the wealth disparity, right? But who are the backers of these bigger donors?
Yeah.
The ultra wealthy, the people that hurts that message hurts, right? So it's like none of these people are going to talk about that because that's where all these super PAC donors and everything is coming from, is from those people that once you wake people up to the wealth gap and all this stuff that it doesn't help them, right? So instead you're like, you got to blame this person and blame that and do this. And it's no one else's fault but yours. And, I think that ultimately that's what you're going to see is like, how do you wake people up? Like anybody will vote for anybody if they get money. Like, you know what I mean?
Yeah.
Like if you, and that's what's sad is like you go to most people who hate Trump, you'd be like, if I gave you 100K and none of your friends have to know, right? Like, people can be bought, and I get it. Like I said, when I had nothing and you came to me and you were like, I'll give you $2,000 to vote for Biden, I'd be like, all right, bro, like, let's do it. Who do you want me to vote for? I don't do it to anybody. I don't care, right? Like, I just need to feed myself. But I think that, unfortunately, um, the socialistic route is probably like where we're headed, which is like my biggest fear, honestly. But I think that if AI really does take over a lot of the jobs that we're expecting it to take over, what else are you gonna do?
Do you think AI can replace you with the way you trade? Or do you think there'll always
um,
be kind of a human edge
yeah.
decision making?
I mean, there's a reason that so there's a couple of things, right? So there's a reason that institutions still have humans like in it. It's not all just algorithmically driven. With me specifically, there is a mechanical aspect that cannot be replicated. So without going like too deep, the way that backtesting softwares and trading bots are built right now is they cannot use multiple time frames. So like what we just did there, like look at the monthly, then look at the weekly, and if this is happening, they can't do that. They can only use one time frame. And the reason for that is because when you're mixing multiple time frames, these indicators repaint themselves and hallucinate. So it'll tell you when you're looking at the back testing data, and I see this with like a lot of my competitors, and I kind of want to be like, hey, bro, like you're going off of data that's not real because I've been there, right? It'll say you would have entered a position at a time that was not real. It's hallucinating because if you're looking at a BX trender, that's one month is 4 separate weeks. So it's
Mhm.
going to repaint all 4 of those weeks at the last week. So like from a logical standpoint and an actual like operational standpoint, that can't replace me because I actually have the ability to look at multiple time frames without repainting and enter at those specific times. But yeah, I do think that in like eventually I could be replaced by AI for sure. But I think too that with AI, like it's just getting dumber. Like it's just getting worse. Like I think the biggest thing is going to be like companies eventually building their own. Like right now, I'm trying to build a small language model based off of all of my information. I don't want the information from Reddit. I don't want the information. Like I'm trying to feed all my playbooks, feed my brain into a small language model that potentially could replace me, like from a talking head standpoint and investing strategy.
So I could see that you could
Yeah.
build your own to trade your way, but I don't think AI can replace people trading or investing in general because the way I see it, everybody at that point, same way with algorithms, right?
Mhm.
Algorithms don't replace humans.
Yeah.
Everyone can have their own algorithm. Everyone can have their own AI that's a little different. And at the end of the day, all those would be interacting in the market and you'd still
Mhm.
have what you still have,
Yeah. Yeah.
right? Which is you have a bunch of humans that have brains, you have a bunch of algorithms that have rule sets, or you can have a
Mhm.
bunch of AI brains, but they're not all the same. They're not all, and at the end of the day, a market's buyers and sellers, right?
Yeah.
So they're not all going to move in the exact same way.
Yeah. And the other thing
So
too is there's just like a lot of limitations. Like I went through the whole trading bot thing for a very, very long time, right? Like I spent 2 years not touching my fund at all and letting it be automatically traded. And it was a nightmare. It was a nightmare because like things break, webhooks break. You're sitting there
yeah,
at work, you think like, oh, it's going to trade for me until it breaks, and then you reinstate the trading bot and you don't know, but you already have a position in the broker and you don't see that, and then it double buys, and then like yeah, like it's not as perfect as you always think it is. And even when it comes to AI in general, until we have AGI, like with quantum computers, there's actually like general intelligence. You still need a human to make sure it's not doing some dumb
yeah,
stuff,
exactly.
right? Like the beautiful thing about AI is, yes, it levels the playing field for people. Where like if you don't know how to code, you could vibe code, you could build your own indicator if you want. But how do you know that it's not lying to you?
Mhm.
You don't. Like if you don't know how to read the code and if you don't understand how that indicator works, it could just be feeding you nonsense. And like I said, I see it happen all the time. These people on X who are like creating the AI thing, and it's like, dude, it's lying to you. Like you have no idea because you don't know how to read it. And that's the thing that has like changed my career. Is like my best friend who also works with me is head of technology. He doesn't know anything about trading, but I can take all the stuff that I'm making and show it to him, and he'll be like, bro, this is lying to you. Don't use this. Or he'll be like, no, this
Mhm.
is fine. This is good. Like, because he understands how code is written. He understands how the system is actually building it. And that's the thing where, like, if you don't have that, then you have no idea, right? Like, I was building out this web application, vibe coding, right? Before I had him actually like take it over. And the vibe coder, I was trying to have it like parse out, like take a CSV file and then like parse it out into like a position sizing calculator. Dude, it literally released. It had a login for like students versus admin, and for some reason inside of it, which I didn't tell it to do, it literally gave every student admin access, like without telling you, like without saying anything. It's just like because it
Yeah.
has no idea what it's doing. So if you're not watching it, it's like that's why I think that so many people think like, oh, AI, everyone's job's going to get taken with AI. Yeah, I think there's a lot that are going to be taken, right? But I also, my hope, going back to the socialism thing, that doesn't happen is that it's going to open up new jobs the same way that like the .com bubble did, right? Like you don't have a woman now like on a typewriter taking minutes, right? But
Yeah.
like now there's new jobs and new things that will open. So that's like my more optimistic
I
outlook.
think that is what will happen. I
Yeah.
think it's can be look, every big technological wave has just created an exponential amount of new jobs behind it. Every single one. And there's no reason to think that AI wouldn't be the same way. Just because we can't think of it doesn't mean it won't be. You know, there's not a lot of people in the 80s that would have thought of internet streamers or I don't know, the idea of
Yeah.
Netflix, you know, or Spotify. You know, like even in the 90s, like these would have been weird thoughts. Um, so I think it'll create a lot more jobs than we know. We just don't know what they are yet
Yeah.
because it hasn't happened yet. To your point earlier, we're just now scratching the surface.
Yeah.
We're pretty like besides LLMs, all we really have out there is Tesla's FSD. Like that's all there is right now with AI. It's LLMs and Tesla's FSD. And so and all this money, all this capex going in, all the research happening right now, there's a lot to come. And don't forget, they're hiring people. You know, so everyone keeps saying that AI is going to replace everyone and it's already happening. First of all, no, it's not.
No.
It's not happening. Like, are people becoming more productive? Sure. Is Janet, you know, a lot better at her job and can handle a little more tasks? So maybe we don't have an extra job opening. Sure, that could happen. I don't consider that replacing a job. That's just you're getting better productivity. But here's my I like taking things to the limit. If AI is already replacing people's jobs and it's so good, where are the layoffs from NVIDIA?
Yeah.
Where are the layoffs from any of the Mag 7s that are AI related? Even Jassy from Amazon came out and said that these weren't AI related layoffs.
Yeah.
You know,
Yeah.
so if the AI company NVIDIA is the AI company, where are all their layoffs? Because, well, I mean, why do they still have sales reps? You
Mhm.
know, like, well, why do they still have demand generation
Yeah.
reps? Well, why do they have HR still? Like, why do they have all this?
Yeah.
Where are their massive layoffs to make, you know, 90% margin instead of their 80 something percent margin?
And I think too that like we're going to see a huge shift in the future, um, to actually going back to more to appreciating handmade things. Like
For
the way
sure.
that like we did like, you know, everything was handmade. And then when we outsource all of our like, you know, building and of things out to like China. Now, when you get a handmade wooden desk from like an
Yeah.
Amish guy, it's so much better than getting something from, you know, Amazon Basics or something like that.
Dude,
And I think that in the premium
100%.
space, yeah, and I think in the premium space, it's going to be the same way. Like, you know, these premium brands aren't going to send you like Porsche isn't going to call you with like an AI automated like agent. Like, would you like to have your like no, like they're going to actually have a human touch who's going to do that. And I think we're going to go back to a world like that. You know, same with music, where what seeing live music is something that is not taken for granted. Having live piece of artwork, like I think that we're going to, as humans, like try to cling on to that more than anything.
I was talking to Farzad about this, Farzad and Hans Nelson, and I was telling them that I think the exact opposite. I think the more AI comes, the more you're going to see more traditional jobs for humans come up. For example, like look, you brought up great examples, but think even more trivial or more common. A really good waiter, a really nice bartender. You know what? I don't like there's something why do we love 1920 themed events, right? Because it's nostalgia and that human, right? Like you're going to want to be served by a really good waiter, a really good waitress. Have someone sit there and smoke that cocktail right in front of you. Like there's that human, that touching grass aspect of it that you're going to want. And I think you're going to see even more of that, not less.
Yeah. And a more appreciation for those as well. Same with a
Way
chef.
more. Yeah.
Like I would way
Yeah.
rather go to
Exactly.
that than like some robot that's like dumping fries in a, but once again, like, you know, I think that I think the idea is more so that it's the lower level versions of
Yes.
everything that will be replaced. Like McDonald's won't be workers. It's going to end up being just a robot that dumps the fries. Like,
Yeah.
you know, a Domino's pizza, like these franchises where like you mix the ingredients, you chuck it in for the same time each and every single time. Like those will actually be replaced. But then once again, too, like here's the thing, right? Like some of those people might have their jobs displaced, but it actually might be a good thing. It might be beneficial. It actually might allow them to go do something else, maybe make more money, have the ability to go explore something else. That's the hope. That's the optimistic aspect
Yeah.
of it. But yeah, I think that that more than anything is a net benefit. I mean, if you look at robo taxis, like yeah, it sucks that an Uber driver will lose his job. But like two things come from that. Number one, the ultra wealthy will want to hire a driver, probably still like a real driver who is not just there to drive them around, but also potentially has security who's also there to talk to, who listen, like that want that human connection. And then everybody else who takes Uber each and every single day and like kind of fears for their safety or the cleanliness of a car, or like just wants to be alone because they're overstimulated. Like they would rather have a robo taxi anyway. Right. So it's
Yeah.
like, I think that it's all going to work out in the end. That's my hope. Right. The whole UBI socialism thing is something that like worries me. And I think that could potentially happen, but like would happen in huge stages. I don't think we'd ever become like full on socialist or anything like that. I do think taxes would just become astronomically crazy that we'd have to have some sort of universal basic income. But
Yeah.
you know, I'm optimistic
Government's
on the
not
future.
efficient enough. You know,
No,
I think,
it doesn't have to be. But that's the thing. Like, it
yeah.
doesn't have to be official. Why would they? Once again, like we said
Well,
earlier, why would you do something if you don't have to?
well,
You know,
I think
like
they're going to have to be is the thing
yeah,
with interest rates or
yeah,
not interest rates, debt. Wow, interest on the debt
yeah,
getting
yeah,
so high, like you're not gonna have a choice. And if anything, that's almost a hedge against socialism
yeah.
because
Yeah, says we just don't have any more
when,
money. We go bankrupt.
yeah, yeah,
Yeah,
no, we're not gonna tax more. Like,
yeah,
no,
yeah,
no, for what? Like, we don't get anything for it. Like,
yeah.
I think people push back. All right, man. Well, it's been a few hours here, so I
Yeah, bro. Coming up on
appreciate
3. It's been
all the
great.
time. And it's been a year and a half, so hopefully it don't take too long. And looking forward to seeing where things go and where you go, and you starting up that pod. So
Yeah, bro. You'll be
I'm
my
gonna keep
first
you to
guest for sure, dude.
that.
And
Awesome.
congrats on being a dad. That's
Thanks,
sweet, man.
brother.
That's awesome.
I appreciate it. And
Yeah.
I should have said at the beginning, but obviously everyone go follow Pete if you're not. I mean, I'm sure everybody is
Thank you,
already,
dude.
but I appreciate you, man.
Yeah, brother. Have a good time or a good day.
All right.
I'll see you,
You
man.
too.
Thank you.
Cheers.
Peace.